morning friends, a warm welcome to all of you on behalf of JK Shah classes. This is Professor Saurabh Bhatt. Today's topic of discussion is the revisionary test paper of November 22, paper 7, that is direct tax paper. Let's start. Now, as far as the November 22 RTP is concerned, the first case scenario is based on provision of section 45, that is on capital gains. If you remember, Finance Act 2021 introduced a provision to tax the amount received on maturity of ULIPs, that is unit linked insurance plan. This question is based on that. Let's look at it. It says Mr. Manoj, aged 45 years, is a resident Indian who has the following life insurance policies, some of which are ULIPs. The details of such policies are given hereunder. Now there is policy number A, policy number B, policy number C, D, E and F. Now if you notice, policy A and B are the traditional policy, which we also call as endowment policies, whereas policy number C, D, E and F are unit linked insurance plans. They have provided us with the date of issue, the annual premium, the date when premium falls due every year, the date of its maturity and consideration received on maturity including bonus and the sum assured. Thereafter they say, during the previous year 21-22, Mr. Manoj has earned dividend income of 12 lakh rupees from shares of Indian companies and long-term capital gains of 5 lakh rupees on sale of land. He deposited 1,50,000 in National Pension Scheme Tier 1 account of government. Mr. Manoj does not opt for section 115 BAC. As we are aware that in case of individuals, if they opt for provision of section 115 BAC, then concessional tax rates are provided in that section, provided the assessee does not avail any special deductions or deduction under chapter 6A. After that, they say, on the basis of facts given above, choose the most appropriate answer to question number 1 to 5 below based on provisions of Income Tax Act 1961. Which of the life insurance policies excluding ULIPs? Now they are asking us in this MCQ to exclude ULIP. As we know that 6 policies are given, out of which 4 are ULIPs. So the first MCQ restricts us to policy number A and B. Then they say, which of the life insurance policy excluding ULIPs in respect of which Mr. Manoj would be eligible for exemption under section 10 clause 10D in respect of maturity proceeds, and what is the quantum of deduction which would be available under section 80C in respect of premium paid on such policies for AY 20 to 23. Assume that Mr. Manoj does not have any ULIPs only for the purpose of answering this MCQ. So they are reiterating that concentrate only on policy number A and B, which are traditional life policies. Now if we look at policy number A and B, first of all, when does the exemption under section 10 clause 10D apply? If you look at the provision of section 10 clause 10D, it clearly says that if the premium exceeds 10% of sum assured, then exemption under 10 clause 10D is not applicable. I will show that for benefit of everyone. Section 10 clause 10D. Yes, it says any sum received under a life insurance policy, including sum allocated by way of bonus on such policy other than, then they have given key man insurance, etc. And then they say any sum received under an insurance policy issued on or after 1st April 2012, in respect of which premium payable for any of the years during the term of the policy exceeds 10% of capital sum assured. If you remember friends that prior to 2012 this percentage was 20%. So in case the policy is issued on or before 31st March 2012, then this percentage is not 10, it is 20. But with effect from 2012, it is 10%. So in case my sum assured exceeds, or rather premium exceeds 10% of sum assured, then the exemption of 10 clause 10D will not apply. So you look at policy number A. Policy number A, the annual premium is 50,000 rupees and the sum assured is 6 lakhs. So is it exceeding 10% of sum assured? Answer is no. 6 lakhs cut 10% is 60,000. This is below that. So policy A, since the premium does not exceed 10% of sum assured, exemption under 10 clause 10D is available. Second policy, if you look at, it says premium is 40,000 and the sum assured is 3,50,000. So is it exceeding 10% of sum assured? Yes, it is exceeding 10% of sum assured, and therefore exemption under section 10 clause 10D is not available in this case. But then they are asking us that to which of these policy 10 clause 10D would be available, and then they say what is the quantum of deduction which would be available under section 80C. Now if you remember section 80C, there are various kinds of investments which you can make and you get a deduction against that, maximum of course 1,50,000. One of them is that if you make payment of premium towards a life insurance policy, then you get deduction under section 80C. However, there is a restriction on that. So, I will show you provision of section 80C. Section 80C says that in computing total income of an assessee being individual or HUF, there shall be deducted in accordance with and subject to provision of this section whole of the amount paid or deposited in the previous year, being aggregate of the sum referred in subsection 2 as does not exceed 150,000 rupees. So, we have inherited our colonial tradition. We don't call it 1,50,000, although these days whenever amendments are made, we notice that increasingly they use lakhs and crores, but earlier we used to say 150,000 rupees. In that subsection 2 clause 1 says that to effect or keep in force an insurance on the life of persons referred in subsection 4, that is self or relatives. But the point is that if you make payment of insurance premium, you get a deduction under 80C. However, this is subject to a condition. If you look at the condition given in subsection 3, 80C subsection 3, it says the provision of subsection 2 shall apply only to so much of premium or other payment made on insurance policy other than contract of deferred annuity issued on or before 2012 as does not exceed 20% of actual capital sum assured. I told you prior to 2012 this percentage was 20, and then they say that with effect from 2012 1st April this will be 10% of actual capital sum assured. So in short, if you have taken a insurance policy and the premium exceeds 10% of capital sum assured, then you will restrict the deduction under 80C to the 10% of capital sum assured. So if you apply that in this example, you notice that as far as policy A is concerned, the actual capital sum assured is 6 lakhs, premium is not exceeding 10% of sum assured. So the entire 60,000 would be eligible for deduction under section 80C. Rather, not 60,000, 50,000 would be eligible for deduction under section 80C. But if you look at policy number B, the actual capital sum assured is 3,50,000 and the premium is 40,000. So is it exceeding 10% of capital sum assured? Yes, it is exceeding, because 10% would be 35,000. So the deduction under 80C would be restricted to 10% of capital sum assured, that is 35,000. So the deduction that you will get is 85,000 under section 80C. So our answer to first MCQ is that policy number A is eligible for exemption under section 10 clause 10D, and the total deduction under section 80C would be restricted to 85,000 rupees. So over here the correct answer would be D. I hope this MCQ was clear to everyone. MCQ number 2, it says, which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption under 10 clause 10D in respect of maturity proceeds? Choose the option most beneficial to Mr. Manoj. Now friends, the history of ULIPs, we have discussed this during our lectures, that unit linked insurance plans are in reality investment opportunities for people who want to invest in markets under the garb of an insurance policy. So although the idea behind ULIP is to make investment in the markets, but various insurance company or rather mutual fund houses have created insurance companies and they present the plan to you or present the investment proposal to you as if it is a insurance plan. The idea for the investor is that you get both, you get the life insurance as well and you get the benefit of investment as well. But government says that since your predominant idea is to make investment, we want to tax the maturity proceeds arising on ULIP. However, let me give a word of caution here. Be it a ULIP or be it a traditional insurance plan, in case the amount is received on account of death of the policy holder, then it does not matter, it will always continue to be exempt. So let's say in this example, unfortunately Mr. Manoj passes away and the maturity proceed is received on either endowment policy or on ULIPs, the entire proceeds would be exempt under section 10 clause 10D, irrespective of whether premium exceeds 10% of capital sum assured or whether it's a ULIP, does not matter. Coming back to our discussion, as far as ULIPs are concerned, government specifically wanted to tax this, hence they introduced a provision in section 45, that is 45 subsection 1b. Now what does 45 subsection 1b say? Notwithstanding anything contained in subsection 1 means this is a non-obstante clause. Non-obstante means overriding clause, where any person receives at any time during the previous year any amount under a ULIP to which exemption under 10 clause 10D does not apply on account of applicability of 4th and 5th proviso thereof, including the amount allocated by way of bonus on such policy, then any profits or gains arising from receipt of such amount by such person shall be chargeable to tax under the head capital gain. So the point is that we need to see whether the ULIP is exempt under section 10 clause 10D. If yes, then no capital gain arises because it's exempt. In case no, it's not exempt under section 10 clause 10D on account of applicability of 4th and 5th proviso thereof, then the proceeds would be taxable as capital gain. So I come back to section 10 clause 10D, and if you notice below section 10 clause 10D, first proviso is given, second proviso is given, third proviso is given, fourth proviso is given and fifth proviso is given. So fourth and fifth proviso, I am reading that. It says, provided also that nothing contained in this clause shall apply with respect to any unit linked insurance policy issued on or after 1st February 2021 if the amount of premium payable for any of the previous year during the term of such policy exceeds 2,50,000 rupees. Why sir 1st February 2021? Because that was the day when budget was presented. As far as this government is concerned, they believe in immediate action. They don't give time. They say immediately, we have got the budget now. If you take any ULIP and the premium exceeds 2,50,000 rupees, then the ULIP would be regarded as capital asset. So let's say that I purchase a ULIP and the premium of that is 3 lakh rupees. Would that be a capital asset? Yes. So would the exemption under 10 clause 10D apply? No, because of 4th proviso. But then our government also realized that Indians are very smart people, especially when it comes to tax evasion or tax avoidance. We are extremely smart. So I, instead of taking one policy where premium is 3 lakhs, I take two policies. Each premium is 1,50,000. I hope you're understanding what I'm doing. Instead of taking one policy, I break it down into two policies, and none of the policy the premium exceeds 2,50,000 rupees. So I have escaped 4th proviso to section 10 clause 10D. So government says sorry, you can't do that, because they inserted 5th proviso which says provided also that if the premium payable by a person for more than one ULIPs issued on or after 1st February 21, the provisions of this clause shall apply only with respect to those ULIPs where the aggregate amount of premium does not exceed the amount referred to in fourth proviso, that is 2,50,000 in any of the previous year during any of those policies. In short, what they are trying to say is, let's say I take 5 ULIPs, then provision of 10 clause 10D exemption will apply only with regard to those set of ULIPs where the aggregate premium does not exceed 2,50,000 rupees. In short, with regard to all other ULIPs, the provision of 10 clause 10D will not apply, and therefore it would be regarded as capital asset and it would give rise to capital gains. If you look at this example, now if we concentrate on C, D, E and F, because MCQ number 2 is specifically based on ULIPs. Now as far as policy number C is concerned, it is issued on 1st February 2021. Policy number D is concerned, it is issued on 1st January 2021. As I told you a while ago, the provision of this ULIP taxation applies for those ULIPs which are subscribed on or after 1st February 2021. In case the ULIP is taken prior to 1st February 2021, then the provision of ULIP taxation, that is 4th and 5th proviso to 10 clause 10D, does not apply. So in short, this continues to be exempt under section 10 clause 10D. So I have to in reality or in effect look at policy number C, E and F, because if you notice E and F, the issue date is after 1st February 2021. Now look at the premiums. They have given us that premium of one policy C is 1 lakh, policy E is 1,40,000, policy F is 2,50,000. Then they tell us that with regard to which of the policy provision of 10 clause 10D exemption will apply. If you look at the provision again, 5th proviso says what? That if premium is payable by a person for more than one ULIPs, then the provision of this clause exemption shall apply only with respect to those ULIPs where the aggregate amount of premium does not exceed 2,50,000. So I will apply 10 clause 10D only to such an aggregate where the premium does not exceed 2,50,000. Suppose one of the policy was exceeding 2,50,000 premium, then the 4th proviso would have applied. Then there is no question of looking at any aggregate, directly it would become taxable. But here I have broken down my policies in such manner, or I have subscribed to different policies in such manner that none of the policies premium exceeds 2,50,000 rupees. So to which of the policy will I apply? There, one of the key words given over here is choose the option which is most beneficial to Mr. Manoj. So what would be more beneficial to Mr. Manoj? Option 1 is take it C plus D, because C plus E, because if you take C plus E, then the premium is 1 lakh plus 1,40,000, that is 2,40,000. And last option is policy F. You take only singular policy F, where the premium does not exceed 2,50,000. Other than that, any option which you take, let's say C plus F, then sorry, it's exceeding 2,50,000. E plus F, 1,40,000 plus 2,50,000, again it's exceeding 2,50,000. So the only two options under which the aggregate of premium does not exceed 2,50,000 is either C plus E or directly policy F. And they are telling us you take such an option which is most beneficial to Mr. Manoj. Naturally, the assessee will choose whichever option suits him the most. So as far as policy number C is concerned, how much is the income arising to Mr. Manoj from that? So concentrate on policy number C. Policy number C was issued on 1st February 2021 and the annual premium is 1 lakh rupees. This policy has a maturity date of 31st of Jan 2030. So in short, I'll pay the premium in 2021 1st Feb, 2022, 2023, 2024, 2025, 2026, 2027, 2028, 2029. So in short, 9 years I will pay the premium and 2030 the policy matures. So 9 years I pay 1 lakh rupees. So as far as policy C is concerned, I end up paying 9 lakh rupees premium, as against which the maturity proceeds are given to me as 11 lakh rupees. The sum assured is 10 lakhs, but the maturity amount that you get is 11 lakhs. So over here, I invested 9 lakhs, I got 11 lakhs, so the gain is 2 lakh rupees. As far as policy number E is concerned, now concentrate on policy E. Policy E, the date of issue is 1st of March and the maturity date is given as 28th of February 2030. So in short, I will invest on 1st March 2021, 22, 23, 24, 25, 26, 27, 28, 29. Again 9 years. So 9 years I have invested an amount of 1,40,000 rupees in respect of policy number E. 9 years. And as against that, how much amount do I get? I get an amount of 17 lakhs. They have told me that I will get an amount of 17 lakh rupees. So how much does this come to? 1,40,000 multiplied by 9 years, that is 12,60,000 minus 17 lakhs. So the gain comes to 4,40,000. So in short, the gain arising on policy C plus E is 6,40,000. The last option is that I take exemption only on policy F. Now policy F, the premium payable every year is 2,50,000. Again, the date of issue is 2021 April and the maturity date is 2030 March. So I hope you again understand 9 years. 9 years I have invested 2,50,000 and I get an amount of 28 lakhs. So policy F, 9 years I invest an amount of 2,50,000 and I get 28 lakhs. So the gain arising is 5,50,000. So where will I claim the exemption? I will claim the exemption naturally wherever the gain is higher. Higher the gain, higher the tax. So better take exemption over there. So I would prefer to take exemption on policy C plus E because higher the gain, higher the tax saving. I hope you understand. So coming back to this question, they are asking us to which of the policies does exemption under 10 clause 10D apply. So policy D, so of course the exemption is available. The date of issue is prior to 1st Feb 2021. So exemption is definitely available, policy D. Then I had option of C plus E or policy F. So as I told you, C plus E, the aggregate of premium does not exceed 2,50,000 and that is more beneficial because the gain is higher. So as a result, the tax saving is higher. So I would prefer to take exemption under C, D and E. So the answer to this would be option C. I hope this is clear. I reiterate in one sentence that policy D, of course I get exemption because it is issued prior to 1st Feb 2021 when the provision itself was not there. So 10 clause 10D applies. Policy C plus E because the aggregate of premium with regard to those two policies do not exceed 2,50,000 rupees. Alternatively, you could have taken policy F, but they have told us that please choose the option most beneficial to Mr. Manoj. So for Mr. Manoj, taking exemption on C plus E is more beneficial because the aggregate tax saving is higher. I hope you understood. Anyway, let's move ahead to the next question. Then they say third question, considering the option chosen in MCQ 2 above. So this is very good way of our institute. If you get one wrong, आगे का सब गलत. Considering the option chosen in MCQ 2 above, what would be the capital gain computed under 45(1)(b) in the hands of Mr. Manoj in AY 3031? Assume that for the purpose of this MCQ, no consideration was received prior to the maturity date. So maturity is only once, that is in 2030. So after this MCQ number 2, things are very clear, because we know 45(1)(b) applies for ULIPs. We also know that policies C, D and E are exempt from tax due to section 10 clause 10D. So C, D and E are not taxable at all. Which is the only one which is taxable? That is policy F. And policy F, how much is the gain? We already know, it is 5.5 lakhs. So the answer over here would be again C, that is 5,50,000. Moving ahead. Next, what is Mr. Manoj's tax liability for AY 22-23? They have given us 4 options. So it's good, one of the option has to match. The risky part is when they tell us none of the above, then you are not sure whether you are, if it does not match, then whether it falls in D or not. So here they have given us 4 options, one of them has to match. Now let's look at the question again. We have to compute tax liability. In the question, I already know that policy B for Bombay, is maturing during the current year. Policy number B is maturing during the current year, and therefore policy number B, whatever maturity proceeds I get minus whatever premium I have already paid, that would be taxable in the hands of assessee. Sir, why is it taxable? Because I told you that the premium paid exceeds 10% of sum assured. Why not policy A? Because policy A, the exemption of 10 clause 10D applies because premium paid does not exceed 10% of sum assured. So if we only talk about policy number B, what is the income arising on maturity of policy B? So this particular policy was taken in the year 2015 and its maturity date is 31st of March 2022. So how many years did I pay the premium? I paid the premium on 1st April 2015, 2016, 2017, 2018, 2019, 2020 and 2021. So I paid premium for 7 years. 7 years I have paid the premium. So that comes to 40,000 multiplied by 7, that is 2,80,000. I have paid premium for total premium of 2,80,000, as against which I have got 4 lakh rupees as the consideration on maturity. So the income arising on maturity of policy number B is 1,20,000. I say this at the cost of repetition. Policy A is exempt from tax, so there is no question of taxing the maturity proceeds of policy A. Sir, what about ULIPs? ULIPs please don't consider, because all these are maturing in 2030. So there is no question of taxing it right now. We are talking of FY 21-22, that is AY 22-23. These will be, ULIPs will be taxable whenever they mature. So as far as the insurance policies are concerned, the income arising on that is 1,20,000. Apart from that, they have told us that Mr. Manoj has derived a dividend income of 12 lakh rupees from shares of Indian company and long-term capital gain of 5 lakh rupees on sale of land. He deposited 1,50,000 in the NPS tier 1 account of government. He does not opt for 115 BAC. So what is the income arising to Mr. Manoj? I can just scribble it down over here. I will say long-term capital gain arising to Mr. Manoj is 5 lakh rupees. And he has got income from other sources. The first one is dividend, that is 12 lakh rupees, and maturity of life insurance policy we already computed, that is 1,20,000 rupees. So the total comes to 18,20,000 rupees. Since he has not opted for provision of 115 BAC, our life is a bit difficult. We have to avail deductions under chapter 6A. Now under chapter 6A, what deduction would he get? First of all, the premium paid on life insurance policy we just saw under section 80C. To the extent the premium does not exceed 10% of capital sum assured, the assessee would be entitled for benefit under section 80C. So already we saw in MCQ number 1 that policy A and B put together, I get a deduction of 85,000. Now if you look at policy C, D, E and F, none of the premiums are exceeding 10% of capital sum assured. So as a result, all these premiums are eligible under 80C. So the maximum you can claim under section 80C is 1,50,000 rupees. So under section 80C, I will avail deduction for life insurance premium of 1,50,000 rupees. Apart from that, they have told us that assessee has deposited 1,50,000 in the National Pension Scheme. Now friends, National Pension Scheme was initiated by the government in the year 2004. In our country, because population is on the rise, government realized in 2004 that its pension outflow was far exceeding the salary and wages payable to the people who are currently in employment. So those government servants who are drawing pension, that cost was higher than the salary payable to those people who are currently working or currently in service with the government. As a result, for those people who joined after 2004 government service, government introduced National Pension Scheme. Later on, they extended that to all assessees, not just government employees, but even people who are private sector employees or other than government employees, as you say, or even to those people who are self-employed. But soon the government realized that people were not motivated to make contribution to National Pension Scheme. The reason being that section 80C plus section 80CCC plus section 80CCD subsection 1, that is for National Pension Scheme, the contribution put together cannot exceed 1,50,000 rupees. The deduction cannot exceed 1,50,000 rupees. So the assessee would say, like in case of Mr. Manoj, that already I am getting 1,50,000 deduction on account of the fact that I have made payment of life insurance premium. So why should I again make investment in any national pension scheme? So government said, don't worry. In order to promote NPS, in fact it's a very good plan. In case your stipend is able to fund it, please do invest in NPS. You all are very young, so you would have a higher pension as and when you retire. So government, in order to promote this NPS, they said that apart from this 1,50,000 rupees deduction, you would be granted a separate deduction under 80CCD subsection 1B. 80CCD subsection 1B, but maximum 50,000 rupees. So 1,50,000, so you are getting 80C plus 80CCC, 80CCD subsection 1, 1,50,000. Apart from that, you would get a deduction of 50,000 rupees under section 80CCD subsection 1B on account of contribution to the National Pension Scheme. Like in this case, has Mr. Manoj exhausted this 1,50,000? No, because he got deduction under 80C on account of life insurance plan. So his 1,50,000, government says it does not go waste. At least an amount of 50,000 out of that, I will allow you deduction under 80CCD subsection 1B. In fact, in my own case, let me tell you all very frankly that I was making payment of insurance premium and PPF. That was exhausting my 1,50,000, so I did not feel the need of making another NPS contribution. But the moment government said that you will get 80CCD subsection 1B extra 50,000 deduction, so I said, why not? Let's open NPS account. So here Mr. Manoj also has opened NPS account and he gets extra deduction of 50,000 rupees. So how much is the total income? Total income comes to 16,20,000. But 1 minute please. Out of this 16,20,000, 5 lakh rupees so is capital gain. So I will say long term capital gain on sale of land is 5 lakhs. That will meet taxation at 20%, and balance normal income is 11,20,000, which will be taxed at slab rates. Slab rates, the assessee has not opted for 115 BAC, so it will be 0 to 2,50,000, no tax. 2,50,000 to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%, and above 10 lakhs it would be 30%. So I will calculate tax, you all can also do that. On 5 lakhs 20% comes to 1 lakh rupees, and on 11 lakh 20,000 it comes to 1,48,500. When I aggregate the two, I get an amount of 2,48,500, to which I will add 4% education cess, that is 9940, and the final answer is 2,58,440. So over here, yeah, 2,58,440, that's the answer. Last one, what would be the total tax deductible under section 194 DA during the previous year 21-22 on payment of maturity proceeds of life insurance policies to Mr. Manoj? Now, you know friends, that's one of the beauties of MCQ type questions. Suddenly the question can move from one chapter to another. In your descriptive questions, big questions, very rarely that happens, because they can touch upon only one or two topics as far as descriptive questions are concerned. But MCQ, one particular MCQ may be based on capital gain, one particular MCQ may be based on TDS, one particular MCQ may be based on penalty measures. So they can move from one chapter to another. So the important thing is that we should also have alacrity of mind. Now what are they saying? That what is the total tax deductible under 194 DA? So you should immediately think that under 194 DA, when payment is made on account of maturity of life insurance policy, which is not exempt under 10 clause 10D, then the TDS would be deducted at 5% on the income comprised therein. If you look at the provision on the screen, it says that any person responsible for paying to a resident any sum under a life insurance policy, including sum allocated by way of bonus on such policy, so whatever amount you are paying, other than the amount not included in total income under 10 clause 10D. So if it's exempt under 10 clause 10D, so no problem, there is no question of taxing it. Other than that, in case it's taxable, then at the time of payment, you have to deduct TDS at the rate of 5% on the income comprised therein. Then they say in case the maturity proceed does not exceed 1 lakh rupees, then there is no question of taxing it, or no question of deducting TDS rather. So here, if you look at policy number A, we already know is exempt under 10 clause 10D, whereas policy number B is not exempt under 10 clause 10D. Because policy B is not exempt under 10 clause 10D, there would be TDS implication under 194 DA. So we already know the income comprised therein is 1,20,000, because you contributed 40,000 for 7 years, that is 2,80,000, as against which you got 4 lakhs. So 1,20,000 is the income comprised therein. What is the rate of TDS? Here we saw the rate of TDS is 5%. So on 1,20,000, 5% comes to 6,000 rupees. So the answer to MCQ number 5 is 6,000, that is nothing but 1,20,000 multiplied by 5%. I hope case scenario number 1 was clear to everyone. Okay friends, now let's move ahead to case scenario number 2. This is based on provisions of charitable trust. It says Edu Aid is a charitable trust registered under section 12 AB. Its main object is education for economically weaker sections of society. During the previous year, it received 60 lakhs as voluntary contributions and 12 lakhs as anonymous donations. The trust borrowed 50 lakhs on 1st May 2021 from State Bank of India for construction of a primary school in a village in Tambaram near Chennai. The trust repaid principal of 10 lakhs to State Bank of India on 31st March. The trust incurred expenditure of 1 lakh on purchase of books for library and 10 lakhs on purchase of computers for junior computer lab. The other applications which are revenue in nature is 7 lakh rupees. This includes sum of 30,000 paid in cash on 14th April for repair job to Mr. Rajesh and 80,000 paid towards fees for professional service on 15th June without deduction of tax at source. The excess application by the trust in the preceding year is 4 lakhs. The trust also received 25 lakhs by way of corpus donation for construction of arts college in Avadi, Tamil Nadu during the previous year 21-22, out of which it deposited 12 lakhs in post office savings bank account in January 22. The balance in post office savings bank account after such deposit is 22 lakhs and invested 8 lakhs in shares of a public sector company in October 21. However, in March 22, due to disinvestment by government, the company ceased to be a public sector company. The trust also withdrew 5 lakhs from post office savings bank account in March 22 and applied the same for construction of primary school in village Tambaram. During the previous year 21-22, the trust spent 72 lakhs in total for construction of the said school. The trust has donated to poor aid. Another trust registered under section 12 AB, 5 lakhs out of its current year income and 4 lakhs out of accumulated income. Out of the amount of 5 lakhs donated out of current year income, 2 lakhs was towards the corpus of poor aid. On the basis of facts given above, choose the most appropriate answer to question number 6 to 10 below based on provision of Income Tax Act. What is the quantum of donation taxable at 30% under section 115 BBC? Now friends, we know that section 115 BBC, which talks about taxation of anonymous donation. What is anonymous donation? Any donation where you do not know the name and identity of the donor. If you do not know name and identity of the donor, in such case, the aggregate of anonymous donation which you receive minus 5% of total donation or 1 lakh rupees, whichever is higher. So, aggregate anonymous minus higher of these two amounts, that is 5% of total donation or 1 lakh rupees. That would be taxable at 30%. Now, if you look at the question, how much is the anonymous donation received by this trust? They have told us anonymous donation received is 72 or rather 12 lakh rupees. So, 12 lakhs is my anonymous donation. Out of that, I have to deduct either 30% of total donation or 1 lakh rupees, whichever is higher. So, total donation, they have told us total voluntary contribution is 60 lakhs and 12 lakhs anonymous donation. So, 60 plus 12, that is 72 lakhs. Apart from that, you have received a corpus donation of 25 lakhs. So, 60 plus 12 plus 25, that comes to 97 lakhs. Of that 5%, 97 lakhs 5% comes to 4,85,000. So, from this total anonymous donation, I would either reduce 1 lakh rupees or this 5%, that is 4,85,000, whichever is higher. So, naturally, which is higher? 4,85,000 is higher. Once I reduce that, how much is the taxable anonymous donation? The answer is 7,15,000. So, the correct option is D. I hope you all understood that. Then they say, question number 7, can the amount donated to poor aid be allowed as application of income in the hands of Edu Aid in the previous year? If so, how much? Now they have given one para on this edu aid, and they have told us, rather poor aid, and they have told us that you have made a contribution of 5 lakhs out of current year income and 4 lakhs out of accumulated income. Friends, under section 11 subsection 2, you are allowed to accumulate an amount for a maximum period of 5 years. But once you accumulate the amount, thereafter within 5 years or the year immediately after that, that is 6th year, you have to utilize the amount for the purposes for which accumulation was made. You cannot give it as contribution to any other trust, otherwise it will become very fancy. Everyone will start accumulating amount. At the end of 5th year, I will form another trust and transfer the amount. So government says that in case any amount which is accumulated and you give it as contribution to any other trust, then it will not be regarded as application of income. So out of your accumulated income, this is your explanation below 11 subsection 2, section 11 subsection 2, which says that once you accumulate the amount, it cannot be given as contribution to any other trust. So in this question, this 2 lakh rupees or rather 4 lakh rupees, which is the contribution given out of accumulated income, sorry, you will not get that as application of income. As far as the current year income is concerned, 5 lakhs, out of that 2 lakh was given as corpus. So we again know that section 11 says that you cannot give any contribution to any person as corpus. If you give it as corpus, then you will not get deduction for the same, because corpus, the one who receives corpus, for him it is not income. So if I give as corpus and I take deduction, then it will be a loss for the government. Government says corpus if you give, for the recipient it's not income, therefore for the person or trust who is giving that contribution, deduction under section 11 won't be allowed, or exemption under section 11 won't be allowed. It will not be regarded as application of income. So the accumulation or rather contribution given out of accumulated income, that will not be allowed as application, and out of this 5 lakh rupees current year income, 2 lakhs is given towards corpus, that will not be allowed as application. So the balance 3 lakhs should be allowed as application. So the correct answer is D. Next one, can the corpus donation received by edu aid be claimed as exempt under section 11 subsection 1 clause D? If so, how much will be exempt? Again, if we look at provision of section 11 subsection 1 clause D, it tells us that any income in the form of voluntary contribution made with a specific direction that they shall form part of corpus of the trust or institution, subject to the condition that voluntary contributions are deposited as per the prescribed form under section 11(5). So tomorrow trust cannot take a corpus and invest it in cryptocurrency. They have to put it in safe investments under section 11 subsection 5. So subject to that condition, if you get any corpus donation, then that would be regarded as exempt from tax. It will not be taxable in your hands. However, friends, please remember that any amount that you have received as a corpus, you have to spend it only for that purpose for which you have received the corpus. Corpus cannot be applied for any purpose as per the whims and fancies of the trust. So let me give you an example. Let us say that I give a corpus donation to NM college, saying that one particular wing of your college should be named after me or my parents or whoever. In such case, NM college cannot utilize that amount received. Once they accept that condition put forth by me, then they cannot utilize it as per any whims and fancies or anything of their choice. They have to utilize it for the purpose of construction of that particular wing to be named after me or my parents or whoever, as per the choice which I made. So that is as per the discretion of the donor. In this example, if you all notice that this edu aid has received a corpus donation of 25 lakh rupees. Now out of this 25 lakh rupees, they have deposited 12 lakh rupees in the post office savings bank account, and they have invested 8 lakhs in shares of a public sector company. That is fine, public sector company you can invest, But in March 2022, due to disinvestment by the government, the company ceased to be a public sector company. Now please understand friends, under section 11 subsection 5, you are not allowed to make any investment in shares other than shares of a public sector company. However, section 11 subsection 5 says that in case on account of disinvestment or any reason whatsoever, the company ceases to be a public sector company, then you are given a time period of 3 years for the purposes of withdrawing that amount from the shares of that company. So I invested in October 2021. The company ceased to be a public sector when I invested, it was a public sector company. That fact is undeniable. In March 2022, it ceased to be a public sector company, not due to my fault. So I am now given a period of 3 years to withdraw that amount from such shares of company. So as on today, March 2022, I am not in violation. I have not done any violation. But if you notice that this particular investment which I have made is only for 20 lakhs. When you get a corpus donation, it has to be invested as per the prescribed modes under section 11 subsection 5. I have only deposited 20 lakhs for the purpose of investment under section 11 subsection 5. Therefore, the corpus donation only to that extent would be regarded as exempt under section 11 subsection 1 clause D, read with section 12. I reiterate that only such corpus donation means what? Where the donor gives it with a specific direction that such donation will form part of corpus of the trust and it has to be utilized for any specific purpose. Now, that will be exempt from tax provided it is invested in the prescribed modes under section 11 subsection 5. Here I have done that only with regard to 20 lakh rupees and therefore only 20 lakh rupees will be the corpus donation exempt from tax. 5 lakh rupees, although I received as corpus, but I did not invest it in the prescribed modes and therefore it would be regarded as taxable in my hands. I hope again that is clear. Next one, question number 9. What is the quantum of amount spent on construction which can be treated as application in the hands of edu aid in previous year 21-22? Now, what is the amount spent on construction? They have told us, yes, they have told us that during the current year, you have undertaken some construction of a primary school and that construction of primary school, you have incurred a total cost of 72 lakhs. In the current year, you have incurred a cost of 72 lakhs. But if you notice, in that 72 lakhs, an amount of 5 lakhs was withdrawn out of post office savings bank account, that is out of corpus, and that corpus amount of 5 lakhs has been utilized towards the construction of the school. Now just think of it like this. I got a corpus donation of 5 lakhs which I invested in post office savings bank account, that is prescribed mode under 11 subsection 5. So in short, this amount of 5 lakhs, did it suffer taxation in my hands? No. But now I am spending it and claiming it as application of income. So government says that this is slightly unfair. When you received the amount, you are not paying tax, and when you spend it, again you are claiming it as application. As a result, the government amended provision of section 11 and this year's in fact very important amendment, we have gone through that in class, which says that any application of income for charitable or religious purpose from the corpus shall not be treated as application of income for charitable or religious purpose. So you received the corpus, you claimed an exemption. Now you spend the corpus, now again you cannot say that this is deductible, and therefore friends, 5 lakh rupees, 72 lakhs is the total construction cost I incurred. Out of that 5 lakh rupees is out of corpus, sorry, I will not get deduction for that. But then in the preceding para, they have also told me that for the purpose of this construction of school, I had borrowed 50 lakh rupees from State Bank of India. Now there is a Karnataka High Court decision of Janmabhoomi Press Trust, where Karnataka High Court says that if there is a repayment of the loan, then repayment of the loan is regarded as application of income. So government said fine, repayment of loan is regarded as application of income, but when you take the loan and you use it for whatever purpose, that cannot be regarded as application. So let me give you an example. Let us say that I took a loan of 5 lakh rupees. I took a loan from bank. Now I used it for construction of school, and later I repaid 5 lakhs to the bank. As per Karnataka High Court decision, when you make the repayment, that is regarded as application of income. Now again, if you take the utilization as application, so there is a double benefit, because you utilize the amount, you claimed it as application, now you repay the amount, again you claim it as application. So government said sorry, double benefit cannot be allowed, and as a result they added that any application of income from loan or borrowing shall not be treated as application of income for charitable or religious purposes. So if you take a loan or borrowing and you utilize that for your charitable purposes, that is not regarded as application of income. When you repay the loan, that will definitely be regarded as application of income. So over here, the trust has borrowed 50 lakh rupees from State Bank of India for its construction. So this 50 lakhs I have utilized in the construction of school, that cannot be regarded as application. But in the immediately next line they say that 10 lakh rupees principal has been repaid to SBI. As I told you, Karnataka High Court says repayment will be regarded as your application of income. So the net application on construction of school would be 72 lakhs minus 5 lakhs minus 50 lakhs plus 10 lakhs. So that comes to 27 lakhs. So the answer to MCQ number 9 is 27 lakhs. That is the amount spent on construction of school that can be treated as application. The next one, what is the total amount which can be treated as application in the hands of EduAid in previous year 21-22, excluding that unconditional accumulation of 15%. So that is fine. Apart from that, what would be regarded as application of income? So for that purpose, friends, we will have to go through the question. In the question, they tell us in the first line that it's a charitable trust registered, it helps economically weaker sections, they have received voluntary contribution, anonymous donation, that's fine. Then they told us that 10 lakh rupees is repaid to SBI, that forms part of my construction of school application of income, 27 lakhs, which I just computed. Then trust incurred expenditure of 1 lakh on purchase of books for library. Now that is definitely an application of income. So 1 lakh rupees would be regarded as application. 10 lakh rupees you have incurred for purchase of computers, that is again your application. But remember friends, in case you have incurred any capital expenditure, it can be claimed as application. But again depreciation cannot be claimed. Section 11 subsection 6 says that if a capital expenditure is claimed as application, then depreciation again would not be allowed on that. It would be regarded as double benefit. The other applications which are revenue in nature is 7 lakhs. This sum includes, so 7 lakh rupees I have spent, that is application of income, but this sum includes 30,000 paid in cash. Any cash expenditure is disallowed under section 40 capital A subsection 3. As per amendment made in the preceding year, provision of 40 capital A subsection 3 and 40 clause A, subclause IA, non-deduction of TDS, that has been made applicable to charitable trust as well. So this 30,000 which you incurred in cash, sorry, this will be reduced, this will not be allowed as application of income. Further they say 80,000 you have incurred towards fees for professional services on which tax is not deducted at source. I told you just now that in case you incur any amount on which tax is not deducted, tax was deductible but you have not deducted, then 30% of such expense would be disallowed. 30% over here comes to 24,000 rupees, so that would be disallowed. The excess application by the trust in the preceding year is 4 lakhs. Now this was a controversy. Madras High Court in the case of Matri Seva Charitable Trust had said that if there is excess application in the preceding year, it can be set off in the current year, rather in the current year it can be claimed as application. But government did not agree with that. Section 11 has been amended. Now any excess application of preceding year has to be ignored. It cannot again be claimed as application in the current year. Apart from that, I have given an amount of 3 lakh rupees to this poor aid. I told you 5 lakh rupees was given, out of which 2 lakhs is towards corpus. So 3 lakhs would be allowed as application, and 27 lakhs we just saw is the application on account of construction of school. So how much is the total application? That is 1 lakh plus 10 lakhs plus 7 lakhs minus 30,000 minus 24,000 plus 3 lakhs plus 27 lakhs, that comes to 47 lakh 46,000. That would be the application of income, 47 lakh 46,000. Answer to question number 10. I hope this question was clear to everyone. Let's move ahead. Okay friends, moving ahead to the next question, that is question number 11. It says ABC Limited is an Indian company which purchases coal from XYZ Limited, another Indian company, for 60 lakh rupees during previous year 21-22 to manufacture steel. ABC Limited furnishes a declaration that such coal is to be used to manufacture steel and not for trading. What are the TCS, TDS implications on such transaction if the purchases were spread evenly throughout the year and ABC Limited's annual turnover was ranging between 12 to 15 crores and XYZ's annual turnover was ranging between 15 to 20 crores in the last few years? Now friends, we know that as per newly introduced section 194Q with effect from 1st July 2021, in case there is a buyer whose turnover in the preceding year exceeds 10 crore rupees, then the buyer is required to withhold TDS under section 194Q at the rate of 0.1% on the purchases made by him. Over here the buyer is Mr. XYZ Limited, and their turnover ABC has purchased. So ABC Limited is the buyer, and ABC Limited's turnover in the last few years has exceeded 10 crores. So in the preceding year definitely it was exceeding 10 crores. So the buyer is required to withhold tax under section 194Q. So C would be the answer. See, once the buyer has to deduct TDS, then you need not look at TCS implications at all. In this question, suppose they would have told us that ABC Limited, the buyer, his turnover was not exceeding 10 crores in the preceding year. In that case, seller would be under the obligation to collect TCS at 0.1% under 206C subsection 1H. But since buyer is going to deduct TDS under 194Q, the seller again is not required to recover TCS from the purchaser. So answer to question number 11 is C, because the buyer's turnover in the preceding year exceeded 10 crores, so the buyer is required to withhold TDS. Next one, a survey was conducted under section 133A in the premises of Mr. Arav, and a search is conducted under section 132 in the premises of his friends Mr. Arjun on 1st May 2021. The assessing officer issued notices under section 148 for AY 1920, 2021 and 21-22 to Mr. Arav and Arjun. However, such notices were not accompanied by a copy of order passed under 148A. Is the action of assessing officer in issuing such notices under 148 to Arav and Arjun valid? Now again friends, with effect from 1st April 2021, the law pertaining to reassessment has undergone drastic change. Now with effect from 1st April 21, in case the assessing officer intends to reopen your case under section 148, he is first required to conduct an inquiry under section 148 capital A, and there he will give you an opportunity, ask you to file details, etc., etc. And thereafter under 148 capital A subsection D, the assessing officer is required to pass an order, and only after that he can either reopen the case if it is a fit case for reassessment, or he may drop the proceedings. They are saying over here that although the reassessment notice under 148 is issued, but there is no order of after the inquiry conducted under 148 capital A which is accompanying such notice under 148. Now please remember, the provision of section 148 capital A do not apply in case the proceedings are initiated because of a search carried out under section 132. Because the idea of 148 capital A is to conduct an inquiry and find incriminating evidence, only post which reassessment under 148 should be conducted. But in case of search, your premises have been raided, already they have got incriminating material. So there is no need for conducting any other inquiry under 148 capital A, and therefore under section 148 the notice issued in respect of this person Arjun would be valid, because in his case search was conducted. However, in the case of that other person Mr. Arav, only a survey was conducted. So post survey the officer is required to follow procedure of 148 capital A. The officer has not done that, so that action would be invalid. So the answer should be C, that is action in case of Arjun is valid because search was conducted, so 148A is not required. But in case of Arav, 148 capital A was required, it's not done, so the procedure is invalid. Next one, transfer pricing. The EBITDA of Ganga Limited, an Indian company, for financial year 21-22 is 800 lakhs. It paid interest of 440 lakhs to Andes Incorporate Brazil, which is a specified foreign company. Now friends, what is this terminology specified foreign company? If you look at provision of section 115 BBD, section 115 BBD states that if an Indian company holds at least 26% shares carrying voting powers in a foreign company, then such foreign company would be regarded as specified foreign company. How much is the percentage? 26%. But for us, what is more important is that in case it's a specified foreign company, means you're holding 26%, means it becomes your associated enterprise within the meaning of section 92 capital A. So over here, this Andes Incorporate and Ganga Limited would be regarded as associated enterprises, and then say the arm's length price or arm's length interest applying cup method was 350 lakhs. So my interest expense is 440 lakhs, but at arm's length it is only 350 lakhs. So I have paid excess interest more than the arm's length of 90 lakhs. Ganga Limited suo moto made transfer pricing adjustment, that is primary adjustment. How much would be primary adjustment? 440 lakhs is the interest that you paid and 350 lakhs is arm's length price. So 90 lakhs is primary adjustment while computing its total income. On the basis of the above facts, examine the correctness of following statement, assuming that no other interest is payable by Ganga. Now in all four options they are talking about 94B, that is your limitation on interest deduction or thin capitalization rules. So let us look at that as well. The EBITDA is given in question as 800 lakhs. We know that maximum interest that would be allowed is 30% of the EBITDA, that is 240 lakhs. As against that, I have paid interest of 350 lakhs. Sir, why 350? Why not 440? Because 440 minus 350, that is 90 lakhs, I have already suo moto disallowed, saying that this is not at arm's length. So 90 lakhs is already disallowed. Again, you cannot disallow it under two provisions, else there will be double disallowance. So 350 lakhs I am saying is the interest at arm's length price, but even that exceeds your maximum permissible 30% of EBITDA by an amount of 110, and therefore the deduction under section 94B would be restricted to 240 lakhs and the excess of 110 lakhs would be disallowed under 94B. So the answer B is saying the excess interest under 94B would be 110 lakhs, correct. Secondary adjustment is required to be made. No, because primary adjustment is 90 lakhs. By adopting the arm's length price, primary adjustment came to 90 lakhs, we know that if primary adjustment does not exceed 100 lakhs, that is 100 crores, then secondary adjustment is not required. So secondary adjustment is not, so this is the correct answer. D is the correct answer. Secondary adjustment is not required in this case because the primary adjustment does not exceed 1 crore. That's point number 1. And the excess interest I will compute by adopting the arm's length interest of 350 lakhs. I have made suo motu disallowance. So the excess would be 110 lakhs. That is answer to question number 13, D. Next one, this I think is based on slump sale. Messrs ABC Limited has two units, Unit A and Unit B, both of which commenced operations on 1st April 2015. It sold Unit B on slump sale on 1st July 2021 for 1.45 crores. Unit B is engaged in specified business of operating a warehousing facility for storage of sugar and has claimed deduction under 35AD in an earlier previous year in respect of entire cost of eligible asset purchased. So 35AD is there along with slump sale. On 1st July 2021, following particulars relating to Unit B are given below. Now they have given us the value of the asset and other details. So they are asking us to compute the capital gain. Now we know, friends, that capital gain in case of slump sale would be taken as FVOC minus the net worth. Net worth is regarded as the cost of acquisition. In case of net worth, let's compute that first. In case of computation of net worth, 3 points we have to remember. First is that if there is any depreciable asset, then the WDV would be considered as per provisions of the Income Tax Act, not as per the books. Second, if the asset has been revalued, then we consider the value of the asset ignoring the portion of revaluation. And third, in case the asset has been used for specified business, already 100% deduction you have got. So cost of such asset while computing net worth shall be taken as nil. So over here the land is taken at revalued figure and they have told us that revaluation reserve attributed to land is 6 lakhs. So my net worth computation, I will consider land at 74 lakhs, that is 80 minus 6. Building, they have given us cost of 50 lakhs, but be mindful of the fact that building was used in the specified business under section 35 AD and therefore 100% of the cost would have been deducted while computing the deduction under 35 AD. So right now building I will consider as 0, nil. Debtors is 12 lakhs, that is fine. Then other liabilities, they have given unsecured loan and current liability. So liability is 20 lakhs, which is also fine. So now after considering this, my net worth will come to 66 lakhs. That is my cost of acquisition. As far as FVOC is concerned, we know as per the amendment by Finance Act 21, now we are required to take FMV1 or FMV2. FMV1 is nothing but FMV of the outgoing assets and FMV2 is nothing but the FMV of incoming asset. Now here there is no incoming asset as such, rather there is only cash consideration coming. So if you remember that formula, E plus F plus G plus H. So there is only E because I have received only money, that is 1.45. FMV1 is the FMV of the outgoing asset. Now in that, in case there is any immovable property, we consider the stamp valuation of that property. Here they have told us stamp valuation is 95 lakhs and 60 lakhs respectively. So I will add 95 plus 60. Other assets remain the same, debtors minus the liability. So this comes to 1.47. How did I get 1.47? 95 plus 60 plus 12 minus 15 minus 5. So which is higher? 1.47 is higher. So I have transferred something for 1.47, of which cost of acquisition is 66 lakhs. So my capital gain would come to 81 lakhs. That would be the answer D. 14th question, the answer is D, 81 lakhs. Next one, Mr. Akash, currently aged 40 years, is an Indian citizen who left India in 2009 for employment in Microsoft. He visited India for 15 days every year up to previous year 17-18. He resigned his job in Microsoft and returned to India with his family on 15th of February 2019. Returned permanently and he opened a startup in Pune on 1st March 2019. He visited USA from 1st June to 31st July both in calendar years 2019 and 2020 for his business purposes. He has a house property in Dallas, USA, from which he derives rental income of $2,000 every month, which was credited to his savings bank account in Dallas. He paid municipal taxes of $200 in December 2021 out of the said account. Interest of $150 was credited in the said bank account in March 2022. In previous year 21-22, he earned business income of 26 lakhs from his startup in Pune, in addition to interest on fixed deposit of 1,70,000 from State Bank of India, Pune. He deposited 1,50,000 in 5-year term deposit with the Bank of India Pune branch out of rental income earned in US. Compute tax liability rounded off for AY 22-23, assuming that $1 stands for 79 rupees throughout financial year 21-22 and it does not opt for section 115 BAC. Now friends, to answer this question, you must have understood first we need to look at the residential status. As far as the current year is concerned, that is FY 21-22, they have not told us that Mr. Akash has left India for any period of time. So I presume that he has stayed in India for the entire 365 days. However, in FY 2021 and FY 19-20, he had visited USA in both these years for a period of 61 days. How do I know 61 days? 1st June to 31st July. So 30 days of June, 31 of July. So that is 61 days. So as far as FY 2021 is concerned, he was in India for 304 days, and as far as FY 19-20 is concerned, he was in India for 305 days. Sir, how 305? FY 19-20 was a leap year. So February had 29 days. Now, as far as residential status is concerned, in the current year, because his stay in India is 182 days or more, he would be regarded as resident of India in the current year. However, he would be regarded as resident and ordinary resident if he was a resident in at least 2 out of last 10 previous years and his stay in the last 7 years exceeded 730 days or was 730 or more number of days. So, in the last 7 years, 2 years to we know, prior to that, he has visited India every year for 15 days. In the current year, he was in India, rather he returned to India in February 2019. Up till 17-18, he has visited India every year for 15 days. So, FY 18-19, because he has returned in India on 15th of February, so he stayed in India for 14 days of February 2019 and 31 days of March 2019, that is 45 days. And prior to that, every year his stay in India was 15 days each. As we know, last 7 years I have to see. In the current year, I was 365 days in India. Last 7 years, so year number 1, 2, 3, 4, 5, 6, 7. 7 years, if you make the total, 304 days in the last year, 305 year preceding that, 45 preceding that, and 60. So, 714 days was his stay in the last 7 years. As I told you, in order to become resident in India, his stay in the last 7 years should have been at least 730 days. He does not fulfill that condition. Therefore, although he is a resident in India during the current year, but he would be regarded as resident but not ordinary resident. Because he is resident but not ordinary resident, his foreign incomes would not be liable to tax in India unless such income arises from a business which is set up in India or business control from India or profession set up in India. That is not the case. He is earning outside India only rental income, and the rental income is also received outside India. So the income is accruing outside India, income is also received outside India. So foreign incomes would not be liable to tax in India. The only income that will be liable to tax in India is his Indian income, that they have told us is 26 lakhs rupees on account of startup venture in India, and 1,70,000 rupees being the interest on fixed deposit. Out of that, he will get a deduction of 1,50,000 rupees under section 80C. It does not matter that such contribution is made out of foreign income, it does not matter. So my total income in India is 26 lakhs plus 1,70,000 minus 1,50,000, so that is 26 lakhs 20,000. He has not opted for 115 BAC, that's why we took the deduction under chapter 6A, and now you would be computing tax at slab rate. So 0 to 2,50,000 no tax, 2,50,000 to 5 lakhs 5%, 5 lakhs to 10 lakhs 20%, above that 30%. So that total for me comes to 5,98,500 plus 4%, that is 23,940. If you add that, it comes to 6,22,440. I hope this question was clear to everyone. The first 15 questions were MCQ based. After that, now descriptive questions are given. So let's look at question number 16. It says, Messrs. Fit and Fair, a partnership firm, commenced operations of the business of a new 3-star hotel in Pune, specified business, Maharashtra, on 1st April 21. The firm, consisting of 2 working partners with equal shares, reports a net profit of 26 lakhs after deduction of the following items. Depreciation as per books of accounts 15 lakh 80,000. Interest on capital at 15% per annum as per partnership deed. The amount of interest is 50 lakhs. Interest on loan includes an amount of 6 lakhs paid to Rajveer, a resident, on which tax was not deducted at source. The firm purchased a new motor car for the above business of 7 lakh rupees on 10th March 2021 and capitalized the same in its books of accounts on 1st April 2021. Further, in April 2021, it incurred capital expenditure of 2 crores, out of which 1.5 crores was for acquisition of land and 50 lakhs on building, exclusively for above business. The firm also installed and put to use new centralized air conditioner costing 3,20,000 rupees. The capital expenditure incurred by the firm were paid by account pay check or use of ECS through bank account. The firm also has another existing business of running a 4-star hotel in Mumbai, which commenced operations 15 years back. The profits from which are 41,38,000 computed as per Income Tax Act for the purpose of AY 22-23. Compute total income and tax payable by the firm for AY 22-23, assuming that the firm has fulfilled all conditions specified for claim of deduction under 35 AD and opted for claiming deduction under 35 AD and has not claimed any deduction under part C of chapter 6A. Now friends, whenever such type of question is asked in exam, they are kind enough, charitable enough to write over there compute tax under normal as well as AMT provisions. They always point out. But over here they have not done that. You need to be mindful of the fact that if the assessee has claimed any special deduction under part C of chapter 6A or 35 AD, then it is required to compute alternate minimum tax if it is assessee other than corporate. Here the assessee is a partnership firm and therefore provision of AMT shall apply. So what I will do is, I will compute the tax liability under normal provision as well as under AMT and thereafter compare whichever is higher, that would be the final tax liability. So over here I will write computation of total income of Messrs. Fit and Fair for year ended 31st March 2022 AY 22-23. Always friends remember, be it a question on AOP or be it a question on assessment of firm or be it a PGBP question or a question based on 115 BBA, always my starting point is net profit as per P&L. So the net profit as per P&L is given to me as 26 lakh rupees. Out of that 26 lakhs, first adjustment, depreciation is given as per books of accounts. Now as per books of accounts, depreciation will always be disallowed. So I will say add disallowances or items considered separately. In that, first item would be depreciation, you can write it in inner column as 15 lakhs 80,000. Then they say interest is paid on capital balance as per the deed, so it's authorized by the deed, that's good. However, the interest paid at 15% amounting to 50 lakhs. We know maximum interest that is allowed is 12%. So if 50 lakhs stands for 15%, how much is 3%? Because 12 would be allowed, excess 3 would be disallowed. So that comes to 10 lakhs. So interest under section 40 clause B is 10 lakhs. Interest on loan includes an amount of 6 lakhs paid to Mr. Rajveer, a resident on which tax is not deducted at source. We know that if tax is not deducted at source, 30% of the amount is disallowed, which comes to 1,80,000 disallowance under section 40A is 1,80,000. Thereafter, they have told us information with regard to claim under 35 AD. So you have purchased a new motor car for the business of 7 lakhs. You have capitalized it in the current year. So 35 AD would be allowed in the current year. So 7 lakhs is eligible. You have also incurred a capital expenditure of 2 crores for the business, out of which 1.5 crores was for acquisition of the land. Land you will not get deduction under 35 AD, but building you will get deduction under 35 AD. Apart from that, you have purchased and installed air conditioners worth 3,20,000. So the total is 60,20,000, which would be permissible under section 35 AD. So less deduction under 35 AD. Please remember friends that in this question they have specifically said that 35 AD deduction is opted for by the assessee. Last year one of the amendments made in law is that now 35 AD is not a mandatory deduction. So if I am, let's say, conducting a specified business but I don't want 35 AD for whatever reason, in that case government will not force me to avail deduction under 35 AD. So in case the question happens to be silent, then that whether the assessee wants to opt for 35 AD, then you should make a suitable assumption by writing a note. In this question they have told me that the assessee wants to avail 35 AD, so 60,20,000 would be the deduction. The disallowances amounted to 27,60,000. So after the disallowances, subtotal came to 53,60,000, and after this deduction under 35 AD, my loss comes to 6,60,000. Now friends, they have told us over here that the assessee firm is also conducting another business of running a 4-star hotel which commenced operations 15 years back. Now please understand friends, as per section 73A, if there is a loss from specified business, then it can be set off only against any profit of specified business. It is not necessary that the specified business against whose profits you are setting off the losses is also availing 35 AD. Means on this Mumbai hotel, even if you are not availing 35 AD, that is fine. But is it a specified business? Yes, because it's running that 4-star hotel. So, loss from the current specified business, that is running of a hotel in Pune, I can set off that loss against the profits arising from Mumbai hotel, irrespective of the fact that Mumbai hotel is eligible or ineligible under 35 AD. So, section 73A says that in case you have loss from specified business, it can be set off against profits of a specified business. Doesn't matter whether that specified business against whose profits you are setting off, whether that is eligible for 35 AD or not, or whether you have availed 35 AD on that or not. So, over here from my Pune hotel, as I just computed, there is a loss of 6,60,000. I have got 4-star hotel in Mumbai from which I have earned profits of 41,38,000. So, I will say profits from Mumbai hotel 41,38,000. So, my net profit from business or profession comes to 34,78,000. Just in order to idiot proof my argument, let me reiterate that this 6,60,000 I am setting off against the profit of Mumbai hotel, because Mumbai hotel is also a specified business. Suppose it was some other business like maybe trading in tires. Now that's not a specified business, in which case that 41,38,000 would be taxed separately and 6,60,000 would be carried forward to the future years. Here, because the other business also happens to be a specified business, doesn't matter whether you have availed 35 AD on that or not, because it was started 15 years back. So you may not have availed 35 AD on that, doesn't matter. But so long as it's a specified business, you can set off the losses of specified business against such profits. On 34,78,000, the tax would be at 31.2%. Sir, how you got this magical figure? 30% plus 4% education cess. That is 10,85,136. But mind you, the answer is not done, because this is the computation of profits and gains under normal provision. Now, I need to compute computation of adjusted total income and alternate minimum tax. Under MAT, we call it as book profits and MAT. Under AMT, we call it as adjusted total income and AMT. Just fun fact that you all know about this, just to reiterate, that if you have opted for provision of 115 BAC in case of an individual or HUF, then provision of AMT is not applicable to you. Now, starting point over here is total income as per regular provisions. So, as per regular provisions, we know that total income is 34,78,000. That becomes my starting point. I will add back the deduction whatever you have availed under section 35 AD. But government says that if you had not availed deduction under 35 AD, I would have allowed to you depreciation under section 32. That much so I would have allowed naturally, even if you did not avail 35 AD. So here I need to see how much depreciation would be eligible for me. So if you look at the question, it says the firm purchased a new motor car for its business of 7 lakh rupees on 10th March 21 and capitalized the same in its books on 1st April 21. So I presume that it was put to use on 1st April 21. So on an amount of 7 lakhs, you get 15% as the depreciation, that is 1,05,000. Further, in April 21, you have incurred capital expenditure of 2 crores, out of which 1.5 crores was for land and 50 lakhs for building. So on land, sorry, you don't get depreciation. On building, you get 10% depreciation, so that is 5 lakh rupees. Apart from that, you have installed air conditioner on 15th of May of 3,20,000. Be very mindful, if it is, let's say 15 November, then you will get depreciation or at half of normal rate. These are, common mistakes made by students. So on this, 15% comes to 48,000. So the total is 6,53,000. That's the depreciation admissible to you. So over here, depreciation admissible, in exam you can always show the breakup, that is fine. So 34,78,000 plus 60,20,000 minus 6,53,000. So 88,45,000 is your adjusted total income. On this, AMT will be at the rate of 18.5%. So on 88,45,000 it is 18.5%. So 16,36,325 plus 4% education cess, that comes to 65,453. So my total AMT comes to 17,01,778. Had the total adjusted total income exceeded 1 crore, I would have also considered surcharge of 12%, but here it's not exceeding 1 crore. Also, the tax which is payable under AMT, because that is higher, so I will end up paying 17 lakhs whatever, minus the tax which was payable under regular provision 10 lakhs, so 7 lakhs odd would be your, or 6 lakhs odd whatever, would be regarded as your AMT credit, which would be eligible for set off in the future years. I hope this question was clear to everyone. Let's move ahead. Okay friends, now let's proceed on to the next question, that is question number 17. It says, Messrs Diamond Industries Limited, an Indian company, is engaged in assembling and manufacture of automobiles and auto components in Indore, Madhya Pradesh. The net profit after debit or credit of the following amounts to statement of profit and loss for the year ended is 9 crore 50 lakhs. So again we know this must be based on computation of total income, and in computation of total income, always the starting point is net profit as per P&L. So I will write down over here net profit as per P&L. ₹9 crore 50 lakhs. Add disallowances or items considered separately. In that, they have said depreciation calculated as per useful life of the asset is 2,80,000. So that's depreciation as per the Companies Act debited to P&L, that would be disallowed. So here I will say first one, depreciation as per P&L 2 crores 80 lakhs. Then donation of 12 lakhs given to a political party by way of account payee check. So whenever you give donation to a political party as per section 37 subsection 2b, that has to be disallowed, but you get a corresponding deduction under 80 GGB. So over here, donation to political party is 12 lakhs. Later on I will claim it under 80 GGB. The company has paid 50 lakh rupees on 15 June 2021 to a research institution recognized and notified by central government, which has as its objects undertaking of scientific research. Now friends, when you give contribution to any notified company or research institution, you get a deduction under section 35 subsection 1 clause 2. However, in case the assessee has opted for 115 BAA or 115 BAB, then 3512 is not available to such assessee. So have they pointed out anywhere? Yes, they have. Assuming that the company opts for concessional tax regime under section 115 BAA. Since the assessee has opted for concessional tax regime under 115 BAA, this 3512 will not be allowed. You have already debited that to P&L, so this needs to be disallowed. Contribution to scientific research institution, that is 50 lakh rupees would be disallowed. Then they have said dividend received from foreign company 15 lakhs in which the assessee holds 30% of share capital. Now this would go under the head other sources. So I leave some space and I will write down here less allowances or items considered separately. In that, dividend would definitely go under the head other sources. Then they say long-term capital gain of 4 lakhs on sale of equity shares on which STT was paid at the time of acquisition as well as sale. So this again would be going under the head capital gain. So I'll reduce it from my business income. Interest at the rate of 10% per annum on 4,20,000 being the amount borrowed from State Bank of India on 1st June 21 for purchase of machinery. The interest outstanding as on 31st March was paid on 1st December 2022. Now friends, please understand, here the most important word is the word per annum. They have told us the interest is paid 10% for the entire year. Per annum means entire year. So in case I am paying 4 crore 20 lakhs multiplied by 10%, that is 42 lakhs for the entire year. Then what is this interest paid for? It is paid for purchase of machinery. We know as per section 36 subsection 1 clause 3, any interest paid on acquisition of asset shall be capitalized up till the time when the asset is put to use. So over here in the additional information they have told me that the machinery was acquired and put to use on 1st January 2022. So 1st January 2022 means that I have acquired and put this asset to use after 9 months. So for a period of 9 months I will have to capitalize this interest cost. So I will say that 4 crore 20 lakhs is my total interest multiplied by 10% multiplied by 9 by 12, that is April up till December, that comes to 1st Jan 2022. So 4 crore 20 lakhs multiplied by this 10% is 42 lakhs multiplied by 9 divided by 12, so that comes to 31,50,000, that would be disallowed. Over here I will say interest under section 36(1)(3), 31,50,000. But then they have also told me that this particular interest which is outstanding on 31st of March has been paid after end of the year but not before due date of furnishing return. Friends, we know that in case any interest is payable to a bank, it is allowable provided it is actually paid. Here it is not actually paid up till the due date of furnishing return, which in case of company is 31st October, and therefore the balance interest would also be disallowed on account of provision of section 43B. So now I look at the fact that this borrowing is made on 1st of June. So 1st June till 31st March comes as 10 months. So on 4 crore 20 lakhs which I borrowed, 10% interest for 10 months comes to 35 lakhs, out of which 31 lakh 50,000 I have already disallowed. So I will say interest under section 43B, the balance that I will disallow is 35 lakhs minus 31 lakh 50,000, that is 3 lakh 50,000. I hope that adjustment is clear to everyone. Then they say next one, profit of 8 lakhs on sale of plot of land to PQR Limited, an Indian company, the entire shares of which are held by Diamond Industries Limited. The plot was acquired on 30th June 2020. Now friends, from our knowledge of capital gains chapter, we know that any transaction between a holding company and its 100% subsidiary is not regarded as transfer. When it is not regarded as transfer, capital gain also does not arise, and this 8 lakhs which is credited to my P&L, I will reduce saying that gain on sale of plot to 100% subsidiary company, that is 8 lakh rupees I will reduce from my taxable income. Thereafter they say salary of 1 crore was paid to foreign technician for installation of machinery at factory premises. So this is my cost which should be regarded as part of capitalization because this was incurred for installation of machinery. So 1 crore rupees would be disallowed. Then they say the company sold automobile parts of 22 lakhs to Messrs ABC Company Engineers, a sole proprietary concern, on 1st November 2019. On 1st Feb 2022, 12 lakh rupees was written off in the books as bad debts. The sole proprietor died on 1st of March 22 and the company managed to collect 11 lakh rupees towards full and final settlement. The entire amount collected was shown as bad debt recovered and credited to the statement of P&L. Now friends, in my P&L, how much amount have I credited? I have credited entire 11 lakhs. So now I will see that 11 lakhs I have shown as income. How much is the actual amount of income which arises on account of recovery of bad debt? So we know that whenever there is recovery of bad debt, section 41 subsection 4 says whatever is the recovery in excess of the unallowed portion, that excess would be regarded as taxable under 41(4). So over here I have sold machinery for 22 lakhs, out of which I claimed 12 lakh rupees as bad debt. So how much is the unallowed portion? 10 lakhs, 22 minus 12. I have recovered against that 11 lakh rupees. So the actual amount of taxable income is 1 lakh. But as against 1 lakh, I have shown entire 11 lakhs as income, and therefore excess 10 lakhs which I have shown as income, I will now reduce from my taxable income. I will say bad debt recovery under 41(4), that is 11 minus 1, 10 lakh rupees will be reduced. This is a very important adjustment. I would like to repeat this. See, as far as recovery of bad debt is concerned, I need to find out what is the unallowed portion. I had sold goods for how much? 22 lakhs. How much did I claim as bad debt? 12 lakhs. So how much is the unallowed portion or unclaimed portion? That is 10 lakhs. So whatever I recover would first be adjusted towards that unclaimed or unallowed portion, that is 10 lakhs. I recovered 11 lakhs. So 10 lakhs which was not allowed, that gets adjusted first, and whatever is the excess 1, that becomes my taxable income. But in my P&L, I showed the entire 11 lakhs as my taxable income. So as a result, excess 10 lakhs which I have shown as my income would now be reduced from the total taxable income. That is what we have done. Then additional information, this I have repeated in classrooms at least 100 times. There are always two types of adjustments in our paper. One is the first type of adjustment where already my debit or credit is given to the P&L. If something is already debited or credited to P&L, when I disallow something or allow something, I need to keep in mind that this thing is already debited to my P&L or credited to my P&L. And second type of adjustment is additional information which is not given effect in the P&L. So the first additional information says depreciation computed as per income tax rules is 1 crore 50 lakhs, out of which other than on additions in asset made during the year. So 1 crore 50 lakhs is the depreciation except depreciation on these additions. So the first addition is office building of 3 crores which was put to use on 15th December 2021. So we know that on 3 crores I would be entitled for 5% depreciation rate, but that would be entitled only for a period of half year, that is 7,50,000. So I will take 7,50,000 over here, office building, plus computers 25 lakhs. 25 lakhs I have put to use on 11th May, so entire 40% is allowable on that, so that is 10 lakhs. And then they say plant and machinery of 5 crores which is installed and put to use on 1st Jan. Now don't forget that this 5 crore worth of plant and machinery, in that I will have to load the cost of technician, that is 1 crore, and the loan which I availed of 420 lakhs at 10% interest from 1st June up till 1st Jan. So that is a period of 7 months that would be regarded as my part of capitalization. So over here I will say that 4 crore 20 lakhs is the capitalization or borrowing which I made for the entire year. 10% is the interest cost on that. So June up till December, so June, July, August, September, October, November, December, yes, 7 months. So 7 divided by 12, that comes to 24,50,000. So my capitalization comes to 6 crores 24,50,000, on which I will get plant and machinery, so 15% depreciation, but for half year, because this asset was put to use after 3rd of October, so I will add 46,83,750 plus 10 lakhs plus 7,50,000 plus 1 crore 50 lakhs. So that comes to 2 crore 14 lakhs 33,750. This is office building. So I think on this one amendment that we need to make is this would be 10% depreciation rate, not 5%. So this depreciation on building would be 15 lakhs, it would not be 7,50,000. So on 3 crores, if you take 10% divided by 2, because half year, so that comes to 15 lakhs. So the addition of entire depreciation comes to 2 crore 21 lakhs 83,750. So that I will reduce over here. Depreciation under section 32, 2 crore 21 lakh 83,750. Third adjustment, they say the company declared and distributed dividend of 12 lakhs on 31st May 2022. So that is talking about ATM, because we know in order to avoid the cascading effect of dividend taxation, if you have received dividend and then distributed dividend, you get a deduction under ATM. Compute total income and tax liability for assessment year, assuming that company opts for concessional tax regime under 115BAA. So I will take a total of this. I will say all these disallowances, they add up to 2 crore 80 lakhs plus 12 lakhs plus 50 lakhs plus 31 lakh 50,000 plus 3 lakh 50,000 plus 1 crore. that comes to 4 crore 77 lakhs. The addition of this plus 9 crore 50 lakhs is 14 crore 27 lakhs minus all these amounts. So 15 lakhs plus 4 lakhs plus 8 lakhs plus 10 lakhs plus 2 crore 21 lakh 83,750, that is 2 crore 58 lakh 83,750. When I reduce from 14 crore 27 lakhs, it comes to 11 crore 68 lakhs 16,250. Apart from that, I have capital gain, that is long term capital gain under section 112A on sale of listed shares of 4 lakh rupees, and income from other sources, that is dividend, I have 15 lakh rupees from foreign company. So my total income comes to 11 crore 87 lakh 16,250, but this is gross total income. From this I will get deduction under ATM, that donation to political party is allowable under 80 GGB, but since the assessee has opted for 115 BAA, 80 GGB is not allowable. Rather, no deduction under chapter 6A is allowable except 80 JJAA and ATM. So over here I will say 12 lakh rupees is the dividend. I received 15, I have distributed 12, whichever is lower, that is allowed as deduction. So 11 crore 87 lakh 16,250 minus this, it comes to 11 crore 75 lakh 16,250. That's my total income. When I calculate the tax, as you are aware, on this 4 lakh rupees, I will calculate tax at the rate of 10% on the gain exceeding 1 lakh rupees. So that would be on 3 lakhs 10%. As far as dividend is concerned, because it is received from foreign company, specified foreign company, that is under 115 BBD, that would be taxable at 15%, and balance income would be taxed at 22%, that is the rate under 115 BAA. On the total of tax, I will add 10% surcharge and 4% education cess to arrive at my final tax liability. I hope this question was clear to everyone. Let's move ahead. The next question, that is question number 18, is based on chapter of business trust. Let's have a look at that. It says, Mr. Rajesh is a unit holder of PQR Limited and Shipra Limited. PQR is incorporated as an investment fund, that is AIF, alternate investment fund, and Shipra Limited is a real estate investment trust, that is your REIT or business trust, which holds 100% shareholding in GPL Limited. So that GPL becomes my special purpose vehicle, SPV. Mr. Rajesh holds 10% units in both Shipra and PQR since 2019. The particulars of income of Shipra Limited and PQR Limited for the year are given below. Now friends, if you remember this chapter, we have already discussed that as far as business trust is concerned, only the interest income received from SPV and rental income received by the business trust and dividend income in case SPV does not opt for section 115 BAA, that would become taxable in the hands of unit holders on a pass-through basis. Other than that, all other incomes earned by the business trust are chargeable to tax in the hands of business trust itself at maximum marginal rate. Other than that, as far as AIF is concerned, in AIF only PGBP income is chargeable to tax in the hands of AIF. Other than that, all incomes would be passed through to the unit holders. So I will just write down over here that Shipra is a REIT and PQR is a AIF, alternate investment fund. And then they tell me first income given is dividend income from GPL. So REIT has earned dividend income from its 100% company where it holds 100% shares, that is GPL, SPV. Now, GPL has not exercised the option under section 115 BAA as far as AY 22-23 is concerned. Apart from that, there is interest income from GPL, that is 3 crore rupees, short term capital gain on sale of development properties 1 crore rupees. As far as AIF is concerned, there is a business income, long term capital loss and interest income. So let's first concentrate on the REIT. As far as REIT is concerned, because GPL has not exercised option under section 115 BAA, this particular dividend income would not become taxable in the hands of the unit holder. Had GPL exercised the option under 115 BAA, then the dividend income would be taxable on pass-through basis in the hands of the unit holder. So over here, dividend income would be exempt from tax as far as the unit holder and business trust are concerned. Interest income from GPL, now that is interest from SPV, definitely taxable in the hands of the unit holder on pass-through basis. They have told us that REIT has distributed 90% of its income, rather both REIT and AIF have distributed 90% of their income to the unit holders. So 90% of 3 crores is 2.7 crores and I am holding 10% of total units. So in my hands 27 lakhs would be the income arising on account of interest from SPV, which is passed through by the REIT to me, that is unit holder. Short term capital gain on sale of development properties, that would be taxable in the hands of business trust, so it would not again be taxable in the hands of unit holder. Let's look at AIF. AIF, as I told you, business income would be chargeable to tax in the hands of the AIF. Apart from that, they have given interest income, that is 52 lakhs. Now 52 lakhs multiplied by I am holding 10% stake, that is 5,20,000 would be chargeable to tax in my hands. Now you might naturally think that, sir, AIF has also distributed only 90% of its income. But please remember friends, in case of securitization trust and in case of AIF, there is a concept of deemed distribution or deemed credit. So even if AIF has distributed only 90% of its income, the balance 10% would be deemed to be distributed to the unit holder as on last day of the year. So that's the reason why this interest income, although 90% of that has been distributed, but the balance 10 would also be deemed to be distributed on last day of the year, and therefore the entire 100% would be chargeable to tax in the hands of unit holders. Out of that, Mr. Rajesh is holding 10% and therefore 5,20,000 would be chargeable to tax in the hands of Mr. Rajesh. So Mr. Rajesh's total income would be 27 lakhs plus 5.2 lakhs, that is 32,20,000. Now you might ask, sir, what about the losses? We have learned this in chapter of AIF that with effect from 2019, the government says now even losses can be passed through to the unit holders. First and foremost, the AIF has to, in step 1, think as if there is no pass through and set off the losses if at all permissible against other income. That is step 1. But here, since it is long-term capital losses, long-term capital loss can be set off only against long-term capital gain. So AIF would not be able to set off. So the balance loss is the same as gross loss, 27 lakhs. That would become passed through to the unit holders. So share of Mr. Rajesh in 27 lakhs would be 10%, that is 2.7 lakhs. However, again Mr. Rajesh does not have any other long-term capital gain to set this off. So this 2.7 lakhs would be carried forward by Mr. Rajesh. If he had any long-term capital gain, I would definitely set it off. In case Mr. Rajesh in the next year has some long-term capital gain, this 2.7 lakhs would be carried forward and set off by Mr. Rajesh. But as far as current year is concerned, his total income is 32,20,000. Further in the question, they tell me that he has opted for 115 BAC and you are required to calculate the tax. That's really simple one, because all that you need to apply is the rates given in 115 BAC No surcharge would be added because the total income does not exceed 50 lakhs. Mr. Rajesh is an individual, so no surcharge to be added, and on the total of tax you will add 4% education cess. So that's fine. Next one, that is question number 19. Now this is based on TDS chapter. I can't remember any attempt where our institute has not asked a 6 marks question on TDS, because more often than not when you become a chartered accountant, one of the first things which your maybe colleagues or maybe friends, relatives or clients will ask you is with regard to TDS, tax deductibility at source, on various payments that they are making, because TDS applies on every transaction. So as a chartered accountant, it's very important that you know the provisions of TDS very well. As a result, our institute also gives due emphasis on this chapter, and every attempt you can expect a question from this particular provision. So they are asking us to analyze the provisions of TDS, TCS in the following cases. Now the first one is based on an amendment, friends, so you need to pay attention, because this amendment has come on 30th of March 2022. So as far as May attempt was concerned, this particular notification was not applicable, but as far as your attempt November 22 is concerned, this notification is very much applicable, being 6 months prior to the exam. Now this amendment is based on provision of 206C. If you remember, friends, we have covered provision of section 206C TCS in that subsection 1G. Subsection 1G says that in case you are remitting any amount outside India under liberalized remittance scheme, in such case the authorized dealer would collect from you TCS at 5%, and in case you are a seller of overseas tour program package, then from the customer who is availing that tour program package, the seller of that package, that is tour operator, will again collect 5% TCS. But one unique scenario arose and a representation was made to the government. What was that unique scenario? Let us say I am settled in US for last 40 years. I come to India to visit my parents. Now after visiting my parents, I tell them that okay, let's go to Sri Lanka or maybe any other country. Let's go for a short trip to Sri Lanka. So I pay 10 lakh rupees to a tour program package for arranging our trip to Sri Lanka. We purchase forex, we do the hotel booking, etc., etc. via this tour operator. Now he will naturally collect TCS from me because 206C subsection 1G requires that. But then I am a non-resident. I am not going to file my return in India and claim this amount as refund. Why will I do that? I have hardly come to India for a few days. So this unnecessarily creates a burden on such non-resident. As a result, in the current year, government has made an amendment and it says that in case you are an Indian citizen who has come to India on a visit, you are a non-resident. See, if you are a resident, then let TCS be deducted or rather collected, and you can claim credit of that in your income tax return. But if you are a non-resident, then in such case, it's not possible for you to file return in India and claim TCS. So in case a non-resident comes to India and he has come to India on a visit, in such cases, even if he avails a tour program package, no TCS shall be collected from this person. So over here, what they have done is, they have told us that Mr. Devansh has come to India for a visit on 15th of February 2022. He is residing in New York. Good for him. Then he has paid 6 lakh rupees to a tour operator, Messrs. Journey Trip, based in Bombay, for a tour package to Malaysia for 1 week. He left for Malaysia on so and so date. Thereafter, he was in India up to 5th of April 2022, on which date he took his return flight to New York. He does not have any other source of income in India. So the point to be noted here is that they have given us the dates in order to find out residential status of Mr. Devansh. He was in India hardly 20 days. So definitely he is a non-resident in India and he has come to India on a visit. So clearly notification number 22 of 2022, that is released in March 2022, is applicable to Mr. Devansh, and therefore provision of 206C subsection 1G will not apply, and the tour operator will not collect TCS from Mr. Devansh. So this is based on an amendment. I reiterate, very important for your exam. Okay. Next one, XYZ Limited was incorporated on 1st April 2021. So on first day of the year, I have been incorporated. Its turnover for the current year is 12 crore rupees. During the previous year 21-22, it purchased goods from Messrs. White Ride, the details of which are as follows. Now they have given us the details of purchases. The above dates represent the date of credit to the account of Messrs. White Ride. Payment is made after 1 month, that is on the same date in the immediately following month. Messrs. White Ride's turnover for the preceding year was 11 crores and during the current year is 9.7 crores. Again, not very difficult to understand. We know that in case purchase of goods are made by a person and the value of purchases exceeds 50 lakh rupees, then the buyer, purchaser, is required to withhold tax at 0.1% on the value of purchases exceeding 50 lakh rupees. But 194Q, that is this TDS provision, is applicable in case the turnover or gross receipts of the buyer in the preceding year were exceeding 10 crore rupees. Now here who is the purchaser? XYZ Limited. What was the turnover in the preceding year? Nothing, because this company is incorporated during the current year. So since I am incorporated during the current year, my turnover in last year was not applicable. Therefore, provision of 194Q are not applicable to the buyer. Now you need to shift focus, because once 194Q is not applicable, for the seller, provision of section 206C subsection 1H are applicable. Now the seller would be required to collect TCS from the buyer. Again, the percentage is the same. However, please note friends, under 194Q the TDS deduction is at the time of credit or payment, whichever is earlier. However, in 206C subsection 1H, the TCS collectible event is when the realization is made, when I make collection from the customer. So as far as White Ride is concerned, Messrs. White Ride, they will be liable to collect TCS because the buyer is not liable to deduct tax at source. And the date on which TCS collection will be made is not the date when sale is made. The TCS would be collectible when the payment is collected, that is given as after 1 month. So White Ride would collect TCS at the time of collection of sale proceeds. Okay, so that was question number 19. After that, question number 20. It says, Mr. Ravi Prakash, a resident Indian aged 52 years, gifted a sum of 30 lakhs to his wife, Mrs. Sudha, on the occasion of her 50th birthday. So the wife is very lucky. Even after so many years of marriage, he is gifting 30 lakh rupees. Good for him. Out of the said sum, Mrs. Sudha purchased a car for 29 lakhs 52,000, inclusive of RTO charges of 2 lakh 15,000, insurance of 51,000 odd, extended warranty of 25,000 odd, and accessories charges of 35,460. These charges were shown separately in the invoice. Mrs. Sudha furnished her Aadhaar number to the dealer. She is a housewife and does not have any income except rental income of 25,000 per month in respect of house property gifted to her by her father. Mr. Ravi Prakash is of the opinion that his wife is not required to furnish return since her total income does not exceed basic exemption limit. Examine. Now first and foremost on your calculator friends, My request is take 25,000 rupees because that's her only income multiplied by 12, that is 3 lakhs, and from rental income you get a standard deduction of 30%. So the net income under the head house property is 2,10,000. Does it exceed basic exemption limit? Absolutely not. So under 139(1), section 139 subsection 1, an assessee other than company or firm is required to furnish return of income provided the total income of such person exceeds basic exemption limit, or as they call it, maximum amount not chargeable to tax. So whosoever is the wife, Sudha, in Sudha's case, definitely the income does not exceed basic exemption limit. But during the last year, our government had inserted a 7th proviso to section 139 subsection 1. In this 7th proviso, government says that doesn't matter, even if you are not required to furnish return under 139(1) because your income does not exceed basic exemption limit, but still we will require you, we will urge you, we will direct you to please furnish a return of income provided you satisfy any one out of the 4 conditions. What are these 4 conditions? First is you have deposited an amount exceeding 1 crore rupees in any one or more of current accounts maintained by you with any bank. So let us say Mrs. Sudha, her income is 2,10,000, but she has deposited 1 crore 1 lakh in some current account of a bank. Then I would say, even though under 139(1) her income does not exceed basic exemption limit, still she is required to furnish return of income because her aggregate deposits are exceeding 1 crore in a current account. So she satisfies one of the condition under 7th proviso. But that is also not the case. She has not deposited 1 crore. Second is she has incurred expenditure aggregating or exceeding 2 lakh rupees for travel to a foreign country. Now that is also not happening in this question. She has deposited or rather incurred an expenditure exceeding 1 lakh rupees towards consumption of electricity. Now that has also not happened, or the question does not provide. But then they say she fulfills any other such conditions as may be prescribed. Now very recently, again this is an amendment, government has notified Rule 12AB, and under Rule 12AB government says that with regard to 7th proviso to section 139(1), clause 4 says that if you satisfy any one of these 4 conditions, that 4th condition is such other things as may be prescribed. We are now prescribing what are those other conditions. So this is a recent amendment. First one is total sales turnover or gross receipt in business exceeds 60 lakh rupees. So Sudha is not conducting any business. Suppose she was conducting a business and her turnover exceeded 60 lakh rupees, she would be required to furnish return, notwithstanding the fact that her total income does not exceed basic exemption limit. But that's not happening, of course. Gross receipt in profession exceeds 10 lakh rupees during the previous year. Now that's also not happening. She is not conducting profession. But look at the third point. The aggregate of TDS and TCS during the previous year in the case of that person is 25,000 rupees or more. However, if that assessee is a senior citizen, in that case that limit will be 50,000. So in case Mrs. Sudha has suffered TDS or TCS exceeding 25,000 rupees, because her age given in question is 50th birthday, so she is not a senior citizen. So in case there is a TDS or TCS exceeding 25,000 rupees, Mrs. Sudha would be required to furnish return of income. Sir, but where is there information given regarding TDS, TCS? It is given, because when they tell us that she has purchased a motor car worth 29,52,000, you should quickly remember the provision of section 206C subsection 1F. 206C subsection 1F says, every person being a seller who receives any amount as consideration for sale of a motor vehicle of the value exceeding 10 lakh rupees shall at the time of receipt of such amount collect from the buyer a sum equal to 1% of sale consideration as income tax. So, where there is a sale of motor car, the person who is selling the motor car will collect from the buyer 1% TCS. So, over here in my question, is there a sale of motor car? Yes, because Mrs. Sudha has purchased a motor vehicle worth 29 lakh 52,000. But in that 29 lakh 52,000, there are certain incidental taxes. So that is RTO charges, insurance, extended warranty and accessories. So these are to be reduced from my sale consideration. If I reduce that from 29 lakh 52,000, in that case, the amount comes to 29 lakh 52,000 minus 2 lakh 15,000 minus 51,575 minus 25,255 minus 35,460. Yes. So that comes to 26 lakhs 24,710. On that 1% TCS would be collected by the seller. So that comes to 26,247. Is that exceeding 25,000 rupees? Yes, that is exceeding. So Sudha would be required to furnish return of income, because although her total income does not exceed basic exemption limit, but she has suffered TCS of exceeding 25,000 rupees, and therefore she would be required to furnish return under section 139(1) read with rule 12 AB. So how nicely, in fact this question is worded quite nicely, because they have moved from 139(1) and suddenly you require knowledge of 206C. So this question is based on return of income, but then they are giving us information with regard to this TCS. So in Hindi there is a famous song, Kahin pe nigahe, kahin pe nishana. So it's like that. They are talking about 206C, but actually the question is based on 139(1). So you require knowledge of both the provisions. Anyway, let's look at the next one. Next question 21. I hope question number 20 was clear to everyone. Question number 21 is pretty simple. This is covered by us in class several times. Asked by institute also once. The assessment of Mr. Whoever was completed under 143(3) of the Income Tax Act with an addition of 9 lakh rupees to the returned income. He contends that the order of assessment is bad in law, as no notice was issued under 143(2), even though he had participated in the assessment proceedings. The assessing officer, relying on section 292BB, contends that since he participated in the assessment proceedings, he cannot raise such objection. Examine the validity of contentions. Now friends, if you remember, section 292BB says that if any notice is served in an improper manner, or it is served after the time limit provided in the Act. What is the time limit for serving notice under 143(2)? It is now 3 months from the end of year in which return is filed. So in case the notice is served after that time period, or it is not served in a proper manner, in such case, the entire assessment proceeding shall be void ab initio, null and void, provided the assessee raises objections to that effect. If the assessee does not raise objections to that effect, then as per section 292BB, the assessee would be precluded from taking a stand that assessment proceedings are null and void at an appellate stage. However, Supreme Court of India in the case of CIT versus Lakshman Das Khandelwal has held that you can cure a defect if the notice is not served in a proper manner, or the notice is served after the time limit provided under law. Here the notice is not served itself. If the notice is not served itself under 143(2), then the assessing authority has not attained jurisdiction to do the assessment. In such cases, 292BB will not apply at all. I reiterate, 292BB will apply provided the assessee has been served notice in an improper manner or the assessee was served notice after the time period allowed under law. If the assessee has not been served notice at all, then there is no question of application of section 292BB, and therefore here the contention of assessee is correct. The entire assessment proceedings are null and void, irrespective of the fact that he has not raised objections to such effect. Friends, in fact, case study based questions, I always tell students, please don't think that if I write more, I will get more marks. It's not like that. You should write the relevant points. And the thumb rule would be that if it's a 4-mark question, write 4 points. Frame 4 sentences in your mind. That's what I did when I appeared for final. So I'm just sharing a tip. That just think in your mind what would be the most relevant 4 points. One of the biggest travesty what happens in exams is that we start writing an answer, we have written maybe half a page and then we think, oh God, I maybe should have written this particular point first. So don't do that. First, formulate the sentences in your mind and thereafter you start writing. And if it's 4-mark question, write 4 sentences, that's enough. If it's 6 marks question, write 6 sentences, that's enough. Doesn't mean that if you are having some 7th point which is most relevant, then you should omit that. I'm not saying that. As I told you, it's a ballpark rule. You can always have exceptions wherein you write 1 point more or 1 point less. But don't think that if I write more, I'm going to get more marks. Please don't do that, because in a paper based on law, if you write more, there are more tendencies that you will make mistake, and if you make mistake, you will lose out on your marks. Anyway, let's proceed on to the next question. I hope question 21, we have covered question 21 in class. So I hope that's clear to everyone. Question 22, this is again based on a new issue, or rather new forum created by Government of India. Prior to Finance Act 2021, we had something called as a Income Tax Settlement Commission. See, Income Tax Settlement Commission is for those assessees who are caught red-handed. They have been issued notices or maybe a search is conducted, and thereafter now they have sudden realization that we want to come clean. They can approach Settlement Commission, they could have approached Settlement Commission, and they could have come clean by disclosing what all undisclosed income, undetected income they have. They would pay the tax along with interest, but they would apply for immunity from penalty and prosecution. So the idea was, and Income Tax Settlement Commission, by the way, you could approach only once in your lifetime. The idea was that once you do something, maybe it's a mistake. If you do again and again, you are a habitual offender, government will not help you. That was the provision of Income Tax Settlement Commission. But in Finance Act 2021, government suddenly, in an abrupt manner, disbanded the entire mechanism of Income Tax Settlement Commission. In fact, it was so abrupt that on 1st February 2021, during the budget speech itself, Honorable Finance Minister announced that now Income Tax Settlement Commission is discontinued. Thereafter, many assessees filed writ petition in high courts, and high courts urged the government to extend that time limit. Finally, the government extended the time limit up till 30th September is another question. But the point is, government on 1st February suddenly announced that now Income Tax Settlement Commission is gone. We don't want to help all these people who are doing big level ghafla or big level tax fraud. Rather, we want to have a forum where small marginal assessees are getting unnecessarily harassed. This forum will help such kind of assessees, small assessees, marginal assessees. And that particular forum is called as Dispute Resolution Committee. In dispute resolution committee, first and foremost, you can make an application provided your returned income does not exceed 50 lakh rupees. And the additions which are made by the assessing officer do not exceed 10 lakh rupees. So your returned income does not exceed 50 lakhs. Your additions made by assessing officer do not exceed 10 lakhs. So it's for very small assessees. For such people, rather than they going in appeal, they can go to this dispute resolution committee. And if they go to dispute resolution committee, whatever is the outcome of dispute resolution committee is binding on the assessing officer. But please understand, friends, in case the additions are made by the assessing officer pursuant to a search or pursuant to any proceedings of smuggling or any other narcotics act has been invoked in your case, in such cases the assessee cannot approach dispute resolution committee. Further, in case the assessee, the additions have been made pursuant to information received from a foreign government under Exchange of Information Pact, then again the assessee cannot approach dispute resolution committee. So over here they have told me that returned income of the assessee is 28 lakhs, fantastic, it's not exceeding 50 lakh rupees. The assessing officer has passed an order enhancing the total income by 5 lakh rupees, so it's not exceeding 10 lakhs, so that's also fine. Now he wants to go to dispute resolution committee. As a tax consultant, I would tell him, please pay that tax on 5 lakhs. Why would you unnecessarily still argue on this 5 lakh rupees? But anyway, to each his own. If he wants to go to dispute resolution committee, yes, he can do that. They have also told us that there is no order of detention made and no prosecution proceedings initiated under any law. So he is not caught under that Prevention of Smuggling Act or any other law which is prohibited under 245 MA. In fact, I would like to show you that list, that if the assessee has been any order of detention has been made under Conservation of Foreign Exchange and Prevention of Smuggling Act 1974, or in case he has been prosecuted under Indian Penal Code or Unlawful Activity Prevention Act, Narcotic Drugs and Psychotropic Substances Act, Prohibition of Benami Transaction, Prevention of Corruption Act, Prevention of Money Laundering Act. If any of these acts are invoked in case of the assessee, order of detention is passed or prosecution is launched, then assessee cannot approach the dispute resolution committee. Or in case the order is passed pursuant to any information which is received by the central government under section 90 or 91, that is Exchange of Information Pact, or the assessee's variations are based on any search conducted, then he cannot approach the dispute resolution committee. I think none of that is attracted in the case of assessee. They are telling us penalty is imposed under 271D for failure to comply with 269 SS. Now suddenly students will wonder, what is this? See, it's not relevant for our answer. 269 SS says if you have accepted a loan aggregating to 20,000 or more otherwise than through banking channels, then an equivalent amount can be imposed as penalty under 271D by the Joint Commissioner of Income Tax. But that's not relevant because the only ground wherein you can't approach dispute resolution committee is provided prosecution is launched. Here prosecution is not launched. They have in fact said no prosecution proceedings are initiated. Mere fact that there is a penalty imposed upon you does not make any difference. So can he approach dispute resolution committee? Yes, he can approach. So they are asking, can Mr. Vijay file the application? Yes, very well, he can do that. If yes, what is the time limit for making application? He is also keen to know whether in case he is aggrieved by the order passed by DRC, can he file an appeal against such order? Would your answer be different if the assessment order is based on information received under DTAA with country X? As I told you friends, if the information is received based on DTAA with any country, in such cases the assessee cannot approach the dispute resolution committee. Also friends, as far as this provision is concerned, let me tell you all that now central government has initiated faceless proceedings for dispute resolution committee as well. So the assessee would be required to appear before this dispute resolution committee in a faceless manner. So you will not know who are the committee members, and because you don't know who is the committee members, the idea is that it will increase transparency. So let me show you this answer, that is to question number 22. You can quickly go through that. Yes. This is also relevant, that he has to make, they have asked us time limit, so within 1 month from date of receipt, and there is no appeal against dispute resolution committee's order. I hope this question is clear. Moving ahead, the next question, a very similar question was asked in your May 2022 RTP, that is question number 23. Again, this is covered by us in class because this is based on a recent case law of Engineering Analysis Excellence Center of Excellence, that is with regard to shrink wrapped softwares which have a end user license agreement. In this context, Supreme Court of India has held that if there is a end user license agreement, then the user gets very limited rights with regard to the particular software, and therefore you cannot say that there is a transfer of rights in software or transfer of a copyright to the user. So in the context of DTAA, payment with regard to such kind of software cannot be regarded as royalty. In the question, they have asked us that will there be any implication of TDS TCS in the hands of the person who has availed the software, and correspondingly whether there will be equalization levy implications as far as the seller of the software is concerned. Now please understand, because this person seller qualifies as a e-commerce operator, the provision of equalization levy definitely applies to the seller. But as per section 165 capital A, in case the payment qualifies as royalty or fees for technical service either under Income Tax Act or DTAA, then the provision of equalization levy will not again correspondingly apply. As I told you right now, that based on Supreme Court decision, we know that payment towards a shrink wrapped software or payment towards a software having an end user license agreement cannot be regarded as royalty under the provisions of DTAA. Since this is not royalty, the provision of equalization levy will apply. So you need to think like this, that if it is a royalty, then equalization levy does not apply. If it is not a royalty, then equalization levy definitely applies. In this case, because it is not a royalty, therefore equalization levy definitely applies to the seller of the software. How do we know it's not royalty? Based on Supreme Court's decision. So that is answer to question number 23. Moving ahead to the next one, this is a very plain vanilla question, simple question. We have done several kinds of same type of question in our class. This is based on double taxation relief chapter, and whenever a question is asked first on double taxation relief chapter, you need to see whether they are asking question based on section 90 or 91. 90 talks about bilateral relief where India has a DTAA. 91 talks about unilateral relief when India does not have a DTAA. If India does not have a DTAA, then under section 91 whatever steps are given, that I need to follow. If you remember, 4 steps are there. Step number 1 is you compute total income of the assessee including foreign income. Step number 2 is you calculate the tax liability on such total income of step 1. Step 3, you calculate the average tax rate, that is step 2 divided by step 1 multiplied by 100. And last step is you take the average rate of tax or the tax rate of foreign country, whichever is lower, multiplied by the double taxed income. So in this question, they have told us that Mrs. Rajni is married and settled in Ranchi. She is a Hindustani classical dancer and choreographer who performs concerts in India and country M. She visits country M every year to participate in whatever. She has earned CMD 10,120 from concerts held in country M. She also owns a residential property in country M, and from which she has earned a rental income of 25,000. She also paid municipal taxes of $200 in that country M dollars. CMD is country M dollars, which is not deductible in country M. This also we have addressed, that we are computing the tax liability in India. Municipal taxes or brought forward business loss set off is not allowed in that foreign country is irrelevant. That is given just to confuse us. In India, is it deductible municipal taxes? Yes, provided they are actually paid. The tax rate of country M is 20%. The entire tax due in country M has been duly paid by Mrs. Rajni. She has earned in India 15 lakhs from dance program performances. Interest she has earned from bank fixed deposit, 15,000 she has earned from savings bank account. They have also told us that she has paid medical premium of 29,000 to ensure her health and 32,000 to ensure the health of her husband, a resident aged 65 years. Mrs. Rajni also is 63, so both are Indian senior citizens. She deposits 1.5 lakhs in public provident fund and 4 lakhs in 5-year fixed deposit in the name of her son, Mr. Priyanshu. The TT buying rate on last day of the year is 69 rupees for $1. Compute total income and net tax payable. Assume that she does not opt for 115 BAC. So the deductions have to be considered. I can directly take you through this answer because it's pretty simple. Same steps have to be followed. So 25,000 is the income from country M, rental income. I will convert it multiplied by 69 as per rule 115. Whenever we talk about rental income, if any income is earned in foreign currency, how you convert it into INR is given in rule 115. And when you talk about rental income, we adopt the rate of exchange as on last day of the year. So 69 is the rate given on last day of the year. So that is 17,25,000. Municipal taxes you are not deducting, that doesn't matter. Yahan pe karo. So 13,800 you deduct that, net annual value arises. 30% standard deduction is allowed to arrive at net rental income. Then in India you have earned 15 lakhs from dance performances. Again outside India you have earned 10,120, that's given in question. So I am on step 1, that is calculate total income inclusive of your foreign income. Then you have given bank fixed deposit and other savings bank interest. As far as deposit in PPF is concerned, 1.5 lakhs is eligible under ATC. Deposit in the name of son doesn't qualify for ATC, but it doesn't matter because as far as Rajni is concerned, she has exhausted 1,50,000 in PPF itself. ATD medical insurance premium for self and spouse is 61,000, but it would be restricted to 25,000 in case of normal person, but here both are senior citizen, so it would be 50,000. 80 TTB because she is a senior citizen. For non-senior citizen, it is 80 TTA, savings bank interest 10,000. For senior citizen, 80 TTB 50,000, and that would include all interest, bank interest, fixed deposit, recurring deposit, savings bank. So 2,50,000 is the total deduction. So total income comes to 35,81,000, on which I calculate the tax in a normal manner. Slab rates 3 lakhs is the basic exemption limit, don't forget, because she has not opted for 115 BAC. So step 3, average tax rate in India. The rate of tax outside India is 20%, so lower of the above is 20. But then I look at what is the doubly taxed income. Here, if you remember, we had discussed the case of Dr. R.N. Jhanji, wherein it was held that you need to consider the net double taxed income. So net double taxed income, first and foremost, 11,97,840 is the rental income. 6,98,280 I will add to that. So that gives me 18,96,120. That's net double taxed income. Here one adjustment, if you all remember, it's not given in this question, but just to bring it to your notice, is with regard to that royalty earned outside India, where you get royalty on books or copyright, you get 80 QQB or 80 RRB. So when you calculate net double taxed income, you reduce that 3 lakh rupees as well, if you remember. So 18,96,000 I'll take lower of the above rate, that's 20%. So I calculate the relief and net tax payable after that comes to 5,40,490. Okay, I hope this question was clear. Moving ahead to the last question. The last question is based on most favored nation clause. If you remember friends, what you mean by most favored nation clause, there are certain countries who are our best friends. So in the DTAA protocol, we write there that this is our best friend, that is, this is our most favored nation. Now the idea is that in case you have a most favored nation for the purpose of tax treaty and later you enter into another treaty with any other particular country, and in that other treaty you have certain more favorable tax rate provisions, then those more favorable tax rate provisions will apply to the first treaty as well. I always give one simple enough example to understand. Let us say in your classroom, it's your birthday. In school, you know, when I was a boy, small boy, I used to distribute chocolates in my classroom. So let's say I have got one best friend. To that best friend I give 2 chocolates. To all others I give only 1 chocolate. So I gave 2 chocolates to my best friend, but as I am distributing, I find another person whom I know pretty well. He asked me for 3 chocolates and I gave him. Now who will be upset? My best friend will be upset. He will say, I am your best friend, but you gave me only 2 chocolates, and to that other boy you have given 3 chocolates. So in order to placate my best friend, I will say, here please take 1 more chocolate, don't worry, you are still my best friend. Similarly friends, in case of DTAA, same thing happens. Let's say for example, now France is our most favored nation, it's our strategic partner. So in case of France DTAA, you have got a most favored nation clause. Let us say tomorrow we have a treaty with some other country, let's say Belarus. Now in that particular treaty I have more favorable provisions. Now who is upset? My best friend is upset. So those more favorable provisions will apply to the first treaty. That's the idea behind most favored nation clause. But here there is an amendment this year. That's the reason why our institute has asked a question. In fact, again a very recent amendment. What the government says, that you have a most favored nation, you have entered into a treaty with another country, that another country's more favorable tax rate provision will apply to most favored nation, provided that other country is an OECD member, Organization of Economic and Cooperative Development member, as on the date when the DTAA is signed. So as on the date when DTAA is signed, is Belarus an OECD member? If yes, then most favored nation clause will kick in and France will also be given the same concessional tax regime as given to whosoever country, Belarus or whatever. Also, the government says that once most favored nation clause is kicked in, we will give a notification saying that this most favored nation clause we are now applying to France or whichever is the MFN country. So please remember these 2 points. Most favored nation clause, even if you have in DTAA, any subsequent treaty will not now automatically trigger in MFN clause. No, you need to see 2 things. One is that such other country with whom you have a subsequent treaty, is that country an OECD member at the time when treaty is signed? That's point number 1. If yes, then also you need to check whether CBDT or government has given a notification saying that this MFN clause now we are applying to the first country. If both these conditions are satisfied, only then MFN clause will be triggered. Let's have a look at this question now. It says Matrix incorporated in country X holds 26% interest in Pillu Limited, an Indian company. Pillu Limited declared dividend of 50 lakhs during the year. DTAA between India and country X, which came into force on 1st Jan 2018, provides tax on dividend at 15%. Thereafter, India entered into a DTAA with country Y, which came into force on 15th May 2018. India country Y DTAA inter alia provides for concessional tax rate of 10% in respect of dividend. Country X is a OECD member since 2015 and country Y is also an OECD member since 2017. Mr. Jack, CFO of Matrix, seeks your opinion on whether concessional tax rate provided in DTAA of country Y can be availed by a resident of country X, and if so, are there any further conditions to be satisfied in this regard? You may assume that protocols annexed to India's DTAA with all OECD member countries contain the relevant tax parity clause. Tax parity clause is nothing but MFN clause. Would your answer change if country Y had become OECD member only in the year 2020? So, first and foremost, in the main question they have said country Y is an OECD member since 2017. When did I enter into a treaty with country Y? I entered in 2018. So, as on the date of signing treaty, is country Y an OECD member? Yes, they are. In such case, if the government gives a notification that country Y tax rate will now be extended to my MFN countries, then country Y tax rate will be incorporated in the DTAA with country X, and therefore dividend would be taxed at 10%. If no such notification is given by government that MFN clause is triggered, then sorry, 15% will be the tax rate which will apply. So let's look at that answer. Please look at this date. It's a recent amendment. CBDT has Wide Circular number 3 of 2022 dated so and so clarified that applicability of most favored nation clause and benefit of lower or restricted scope of source taxation rights in relation to certain items of income including dividend provided in India's DTAA with third states will be available to the first state only when all following conditions are met. The second treaty is entered into after the signature or entry in force between India and first state. So this is the understanding of MFN right since beginning. Like in my example I told you, I gave 2 chocolates to my best friend, then I am distributing in class. So there is a subsequent treaty. I entered into a treaty with country X, now subsequently I am entering into a treaty with country Y. So the treaty with MFN country is entered first and subsequently there is a treaty. Now that is definitely satisfied because DTAA with country Y is entered into in May 2018, whereas with country X I have already entered into treaty in January 2018. The second treaty is entered into between India and a state which is member of OECD at the time when the treaty is signed. Can you see that highlighted part? So I need to check whether country Y was a OECD member as on the date when treaty is signed. That is again satisfied because they are OECD members since 2017. India limits its taxing rights in the second treaty in relation to rate or scope. So the second treaty has got more beneficial provision. Of course, otherwise why would MFN clause be triggered? Suppose in my treaty with country X 15% taxation is given on dividend, in some other treaty it is 20%. Then there is no more beneficial tax rate. So where is the question of applying MFN? Here definitely MFN is triggered because in my treaty the tax rate is given as 15%, whereas in a subsequent treaty a more concessional tax rate, that is 10%, is given. And last, a separate notification has been issued by India importing the benefits of second treaty into the treaty with first state as required by the provisions of section 90. Now this, the question is silent. In case the government has issued a separate notification saying that country Y provisions of DTAA will now apply to our MFN country X, only then would the provision of most favored nation clause be triggered. So if there is a notification to that effect, then 10% would be the tax rate incorporated as far as country X tax treaty is concerned. If there is no such notification, sorry, MFN clause will not be triggered. They have given us an alternate question wherein they say that if you have become OECD member, country Y has become OECD member in 2020, then definitely MFN clause cannot be applied, because at the time when the treaty is signed with the other country, MFN, that particular country was not a member of OECD. So the condition would be violated. So these two conditions, please do remember. One is when you are entering into a treaty which is subsequent to a treaty with MFN country, in that subsequent treaty, whoever is the country should be a member when the treaty is signed. They should be a member of OECD. And second, the government gives a separate notification to the effect that such subsequent treaties provisions or the more beneficial provisions would be now incorporated in the first country's treaty by way of MFN clause. Don't forget these 2 points because they are recently added by CBDT Wide Circular number 3 of 2022. That's it, friends. I hope the RTP was clear to all of you. I wish you all the best for your exams. Good luck. Take care. Thank you.